some, and maybe short term, but longer term, the thesis now in the commodity world, at least the way people are talking about it, is that decarbonization theme. Cities saying you could hit copper $12,000 over the next 3 to 4 months. Like, that's pretty close. And this is a cool chart, guy, that I wanted to share with you real quick. So this is Citi's chart, and the orange bar here is their base and bull case demand from other stuff. And the blue bar is the demand for copper from things like charging stations, power capacity, grid storage, EVs, all the decarbonization theme. And you can see starting in 2022 how much that demand actually grows in relation to the other stuff that copper's used for. And that's sort of the real case for why some investors are very bullish on the copper market.
You do wonder how much substitution there might be, though, in this case, and how high prices could go, and whether aluminum could end up taking some of that market. Well, let's talk about this in a little bit more detail with somebody that really knows what they're talking about. I'm not talking about Alex, I'm talking about Richard Atkinson, Freeport-McMoRan, Chairman and CEO. Richard, thank you very much indeed for your time today. We really appreciate it. Look, let's try and answer the question that Alex just posed. What is your outlook for copper, and do you think the Chinese, if they do lean in on the rally that we've seen, will have much impact?
Well, there's a difference between short-term impacts and long-term impacts. The copper business is a very long-term business. I mean, investments require long periods of time. Demand emerges in a long-term way. In the short run, actions can have an impact. Commodity trading can have an impact. But the commodity market for copper today is extraordinarily strong. It's both on the demand side, and we've got new sources of demand that you've been talking about, and supply scarcity is a real factor in the marketplace.
Well, let's get to that supply scarcity, because, Richard, in some industries like oil, it's become much more short cycle with the evolution of new technology and shale. Can you explain to us why that isn't happening in the copper market?
Well, I like to say there's no shale oil for copper. And we watch for technology changes. We just had Bob Dudley to our board from retired CEO of BP, and he was comparing the differences for our board between copper and oil. Today, the top 10 copper producers in 2021, top 10. The most recent discoveries was our Grasberg mine in the late 80s. There was one other mine in the early 80s. The last most recent discovery was 50 years ago. So unlike the oil industry, where you have an ongoing flow of discoveries and now the new element of shale coming in, copper mines of size, and these 10 mines produce almost 25% of the world's copper, are very rare to find. Grades are falling in existing mines. Newer mines that have the possibility of being developed are much lower quality in terms of grades and their location. So it's it's hard to find another commodity that has a supply side support that copper has. And now we've got a new era of copper demand where we're not just relying on China's growth for new demand, but lots of things for growth outside China.
Richard, let's just talk a little bit about substitution and demand destruction. If prices get too high, copper's great at conducting, but you can use aluminum as well. Do you think if prices get to the point much further than where they are now, we're going to see significant substitution?
My view is demand's going to be so strong, supplies of copper are going to be limited, that substitution will be required. Scrap will have to emerge to fill the gap. People have been talking about substitution for copper for 30 years, but copper has such strong advantages physically in conducting electricity that it creates a real barrier to substitution. But with this coming gap that we're going to have between demand and supply, the world's going to have to find ways to substitute just to operate. But when that happens, it's going to be in the context of a very, very strong copper price.
Richard, how long do you think that supply gap is going to last? So the two ways that I'm thinking about it. One is that ESG, higher input costs, higher taxes in certain countries like Chile and Peru are going to dramatically raise the cost curve, so therefore you're not going to get a lot of supply. The other is that everyone's going to go mine bananas because they want to take advantage of $10,000, $12,000 copper, and we're going to end up with a more deflationary scenario. Which one are you thinking is going to play out?
The problem with the second point you make, that supply is going to emerge because in the near term, because of high prices, it can't happen in our industry. This began, really, the supply challenge began in the early 2000s when China emerged. And since then, mining companies have gotten to be very large, well-capitalized, technically strong, and have had a focus on trying to develop new copper supplies. And they just haven't been able to do it. We've got a new world today with all the, with carbon reduction, things outside China creating growth. I believe our company has the best portfolio of undeveloped resources, reserves and resources. They're brownfield opportunities with our mines. And if the price of copper were to double today, we would not have significant new production for 5 years or more.
Wow.
Richard, governments around the world are looking at this, and while shareholders are reporting companies' fiscal discipline and the fact that they haven't been out and spent this cycle, and that seems to be the new watchword, governments don't play by the same rules. They're going to want their tax take. Do you expect that copper miners are going to have to pay significantly higher taxes in the environment you're describing?
Government aspirations for revenues, workers' aspirations for revenues are all correlated to the copper price. And so to start with, we've always had a philosophy of making sure that governments and communities have a fair deal in our operations. And in most cases, they get 50% or more of the revenues, or 40 to 50%. So that's going to be a factor. What's so tempting for governments is, I talked about our business being long-term. We make these investments in developing new mines, and then we have decades of production afterwards. Governments try to attract us to make the investments by offering attractive terms. Once those investments are made and revenues start flowing, prices go up, governments see that as a source of revenues. This is not a new factor. It's things we've had to deal with over our history, but in today's world, it's a real factor.
Richard, before I let you go, I could talk to you for hours, but before I let you go, the same reason that we have a supply shortage in copper could also affect you on the input side, whether it's freight or labor or oil or steel or whatever. What are you noticing on the ground right now that you just can't get a hold of?
Oh, we've got a hold of it, Alex. I mean, we've been in this business a long time. We've got a real strong supply chain organization. We operate every mine we have an interest in. So in the Americas, we run all of our Americas mines as one business. We have this big mine in Indonesia. So for many of our suppliers, we're their largest customer. And so we certainly have our arms around it. Some of our costs are correlated to the copper price. You know, energy is 20% or so of our costs. Labor costs rise. Input costs, some input costs rise. But the great thing about our business is our margins are expanding. You know,
really? Costs
go up, but our margins are expanding because copper is right at the top of the list of the commodities that's rising so much. And I know we don't have time, but there's a lot of company-specific things that are going well for Freeport. We've had a long journey to get where we are here today, but man, we're really set up now. Our Indonesia mine is being expanded. Volumes are rising, costs are going down. We're moving underground at a scale that's never been done before in the history of the industry. We're applying technology to reduce costs and increase volumes in the Americas. We're looking at some new leaching technology that could be very important for us. I've been in this business a long time. 10 years ago, our company was in a similar situation. I've never felt better about where our company is right now and where the markets are that we sell products into.
Richard, you come back, you tell us more about what is going on with the company specifically. We'd love to have you back anytime. Thank you very much indeed. Richard Adkisson, Freeport's Chairman and CEO. For more now, let's bring in Grant Sporer, Bloomberg Intelligence Analyst for metals and mining. Richard paints a really positive picture. He's feeling as good about this business as he has in a very long time, 10 years he talks about. Is it as good? Are there headwinds on the horizon?
Where we stand today, things do look very positive for the outlook for copper. I guess the debate we have to tackle or grasp is, will China, we're already seeing their credit impulse starting to slow.
Yep.
Typically, there's about an 8 to 12-month lag between when that starts to impact the commodities. Richard talked about China having less of an influence, perhaps, on commodities than they have previously. So we still have to see whether that's going to be the case. So I think the sort of nervous point for commodities in general on previous correlations would be at the end of this year. And if China really want to have an influence, they will slow down their credit and just cool things off in the economy. And that will have an impact, in my view, on commodity prices.
100%.
So that's one risk factor.
Yeah, and you can definitely look across the spectrum for metals on that, too. Hey, Grant, you know, we saw in the oil community in the last 24 hours a super big push on the ESG level, mainly the E. Is activist investing and greening copper mines, like, where are we in that conversation? Like, is that industry next? Like, are we having to see that happen?
Well, in fairness to the copper industry, they've been working hard to green their operations for quite a while now. So particularly in Chile, as an example, they've been switching to renewable energy. That's been economically viable over the last few years. So that's really helped them. So I think by 2023, most of the mines will be all renewable. And also water is obviously a big factor in Chile. And many of the mines will probably get to sort of 50% over the next 3 to 4 years, where they will use desalinated or seawater. So they have been pushing hard. They are trying to implement new technologies to recycle more water, generate less tailings. So they're very focused on that. So I would argue that they are, I wouldn't say ahead of the curve, but certainly keeping up with the environmental expectations.
Okay, they're in the curve. Okay, fair enough. All right, Grant, thanks a lot. Really appreciate it. Grant Sporer of Bloomberg Intelligence. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The demand for WeWork space today is higher than it was prior to the pandemic. So what the pandemic allowed WeWork allowed to reinvent itself, it allowed to learn how to operate on a most cost-flexible basis.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Well, President Biden is looking to unveil a budget that is about $6 trillion in annual spending. Want to get more on the impact of that for Bloomberg's international economics and policy correspondent Mike McKee. In the speech, one of the lines he said, the pre-release said, the time is now with low interest rates. It's really good for infrastructure investment, starting to make his case for that huge budget deficit. What's your take?
It's been something economists have been talking about for a long time, with the costs so low to borrow and spend now to invest in the economy in the future. And the president's budget, which officially comes out tomorrow, some of the documents leaked to the New York Times today suggest that he's going to take people up on that. You can see there $6 trillion in spending proposed for fiscal 2022, and you can see the magnitude of the difference. It's another $1 trillion in spending over what we spent this year for his American Jobs Plan and American Families Plan. If they pass, he'd get up to $8.2 trillion by 2031.
Mike, I don't normally quote the New York Times on this program, but the last line in the New York Times article a little bit earlier on, I think sums up one of the big problems that the administration, the country may face. Even if interest rates stay low, payments on the national debt will consume an increasing share of the federal budget. Net interest payments would double as a share of the economy from 22 to 2031. What do you think the Fed thinks about that problem?
Well, it's going to depend on the growth assumptions, which are actually quite conservative. And you can see there the chart basically shows where we are now, a little over 100% of GDP. That would rise to 117% of GDP by 2031. If growth is faster than the increase in the debt spending, then you can pay for it, and it's not a problem. The issue is if growth is really slow, and the odd thing is the administration seems to be predicting we will get a growth spurt for a year or two, and then it will be no better than around 2%, which is where we were as far as potential growth. If it doesn't lift higher than that, then you'd have a problem down the road, and that might be an issue in trying to sell this program.
Yeah, no kidding. Okay, so realistically, you've covered D.C. for a long time. Where do we end up?
The president has a good chance because of the Democratic House and Senate of getting a lot of this, but not all of it, because there are conservatives who aren't going to want to spend that much money, even in the Democratic Party.
Fair enough.
Yep, this is what it all comes down to. Mike, thanks very much indeed. Bloomberg's Mike McKee. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishka Gupta. More legal trouble for Amazon. Bloomberg has learned that attorneys general from Massachusetts and Pennsylvania have joined the list of officials looking at the online retail giant for potential antitrust violations. That list had already included several states and the Federal Trade Commission. Amazon is accused of using its market power to crush rivals and vie for business against third-party merchants. And Best Buy is boosting its full-year sales forecast after the revenue soared in the quarter. The electronics retailer was fueled by what it says was extraordinarily high demand for its products. Best Buy said it now sees company-wide comparable sales rising between 3% and 6% this fiscal year, after previously forecasting them to land somewhere between a 2% decline and a 1% gain. And ExxonMobil CEO Darren Woods has been dealt a stunning defeat by shareholders. A tiny activist investment management firm snagged at least 2 board seats and promised to push the crude driller to diversify beyond oil and fight climate change. It was the latest setback for Woods. The oil giant, once the world's most valuable company, has shed more than $125 billion in market value during his tenure. And that is your latest business flash. Alex, Guy?
All right, thanks so much, Ritika. What I thought was fascinating on so many levels with this, but it wasn't just with Exxon, Guy. Shell yesterday had a defeat in the Netherlands, which said that they have to cut their emissions faster than they planned. Chevron, there is now a shareholder vote that was approved that they have to disclose and work towards reducing Scope 3 emissions, which for an oil company is basically the products that you use, is ridiculously hard. And that's a sea change from the normal, like, here's my, here's my proxy or here's my suggestion in the AGM.
Let me throw a few more things into there as well. I think the Shell case is interesting, and I think it's going to be interesting to see whether other court cases go this way. But you had the IEA the other day, and we talked about this then, basically saying no new projects. I thought that was a huge development. Did you see the case down in Australia? I think it was 8 teenagers and a nun bringing a case, which basically was against the coal plants and the duty of care in terms of the current generation to look after the future generation. There are a lot of things happening very quickly here.
But see, and you raise that point, is that they're always those guys. Like, they're always the little people that come out and say, here, vote for this in the AGM, and they make it or they don't or whatever. But this was different because this was 0.02% of Exxon shares. Okay, it's not a lot, but it was still $53 million compared to what the other suggestions come out to be. And they spent like $35 million on this.
Yeah, but the tide is turning. I guess my point is that it's not... these shareholders don't, as you say, now feel like an ignored minority.
Yeah.
They are starting to have a meaningful impact. You've seen the same thing in the court case relating to Shell. That is a huge shift. What is it? They've got to cut 45% of emissions by 2030. That's a massive, massive move that they've got to make. The fact that the IEA has come out, all I'm saying is that in aggregate, I think Exxon is interesting, but I think it's part of a wider narrative. I think the pendulum is swinging and it's starting to accelerate really quickly.
I obviously don't disagree with that. However, I wonder if it would have been this fast if we hadn't had a pandemic and oil prices didn't go negative, and that oil companies got hit so hard that it also helped to fuel the shift, because you could look at things like profitability. What was different about Engine 1 is that they looked at profitability and they said, like, you have not returned, had the right kind of return that we want.
You are not
that was the difference.
Yeah, and then I think there is a wider question that I think investors have got to figure out is, can these companies, should you just put these companies into runoff, or can they make a transition? And how expensive is it going to be to make that transition? And I think these are questions you have to answer as well. And it's interesting to see what's happening with the ESG narrative and what's happening with energy stocks, etc. Kind of people making their decisions as to which way they want to go on this. There is going to be a transition, we know that, but where are these kind of companies fit into that?
And I think that's where Exxon was trying to stake claim and say, we still need oil. So, like, where are you going to get it? We should be the ones then to produce it because we do it so well and we have so many assets. So, but anyway, obviously, we're both really into this topic.
But how do you value that? I think it's really tricky.
With the dividend.
European close coming up next. We'll be talking to Marilyn Watson. She's going to be joining us from Miami, from BlackRock, giving us her take on what is happening, particularly this kind of move towards a taper. Which direction's the Fed going in? Which direction's the ECB going in? We'll talk about that next. This is Bloomberg.
The world economy is going to be $9 trillion richer between now and 2025 if vaccinations are accelerated.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Minutes to the Thursday close. Here's what you need to know out of Europe this hour. Boris Johnson sounds a note of caution on the reopening. UK cases continue to rise. The pound doesn't care, though. Comments from the Bank of England's Vliet saying that rates could rise sooner than expected, sending the pound sharply higher. Airbus stock also soaring today as it tells suppliers to plan for a massive production ramp of the 320 narrow-body family. And Rolls-Royce, the car company, unveiling a custom car with a retro design that's rumoured to be for an American rapper. We're going to hear from its CEO on demand, electrification, and this new boat tail design. It's Thursday. It's time to have a little bit of fun. Let's talk about the markets. We are higher today, up by around 0.4% on the Stock 600. The action actually this afternoon, I think in the currency markets, those Flehay comments really having an impact on the pound. As you can see, we're up by around 0.5%. And within the last few minutes, you're getting quite a big spike in dollar-yen, Alex.
Yeah, I'm trying to look for a headline on that, but I didn't see anything in particular. I mean, broadly, though, it is a weaker dollar story. I'll start at the bottom of the board on that because you have the New Zealand dollar up by 0.2%, up for 4 straight days, 5 straight days in a row now. Nope, that's 4. 4 straight days in a row now. I'll get it right one time. And that's really because New Zealand is sort of inching to removing some of that really accommodative policy, as Guy was talking about, though. The bond market is selling off. Here in the U.S. is no different. All the gilts are really the underperformer, with yields pushing higher by about 3 basis points. Let's go to the equity market here in the U.S. The Russell 2000, so that's outperforming up 0.8%. You have jobless claims hitting a post-pandemic low, and you also have a second read on the first quarter GDP still coming in really strong. That business equipment spending very, very strong. And Ford, this is the fun one. Ford is up by almost 8%. That's a Reddit thing. Apparently, this was the biggest gainer on the S&P yesterday, Guy, and that is a pure Reddit, let's squeeze the shorts trade like the GameStops and the AMCs of the world.
Yeah, we're not done with that one, are we?
No,
Let's turn to central banking. Let's turn to central banking. I'm not sure how you go from GameStop to central banking, but I think there probably is a link via QE. ECB officials are indicating they are in no rush to pull back on bond buying just yet. The Fed, though, not so sure. What's interesting is that a few days back, it was always almost kind of completely the other way. Richard Clarida now saying there may come a time at an upcoming meeting to talk taper. ECB Governing Council member Yanis Stounaras talking a more cautious book, saying, I don't see any reason to make any change to the pace of the PEP programme at the moment. I had the programme bit there. Joining us now to talk about the divergence that we're seeing, Bloomberg's Christina Aquino, who leads our FX bonds and emerging market coverage here in Europe. Good afternoon, Christine. A few days ago, the mood music started to shift towards the fact that the ECB might actually be looking to taper some of its purchases. The market started to price that in. The Fed looks like it was very much on hold, that the taper was going to be pushed back a little bit. The mood music has completely changed over the last few days. What impact is this having in the market? Because I see what is happening in the European bond market, but the Fed and the impact there in terms of the bond market on the Treasury story, very limited.
Yeah, absolutely, Guy. And it is a very interesting shift in the messaging as well as the market reaction. And I think it is probably a case of, we've just started to see the mood music for the Fed turning a little bit this week after they've been saying for a few weeks now, and especially since their last Fed meeting, we're going to hold, we're going to stand pat, we're going to see what the data looks like. And I think a lot of people in the markets are still kind of holding on to that. And they are taking the comments that we've seen now from Clarida. We also had Randy Quarles yesterday talking a similar note, and it is starting to kind of filter through, but probably not enough to kind of see that big run up in Treasury yields. In Europe, in the meantime, it's kind of the opposite way, right? We at some point, just a couple of weeks ago, we were at the precipice of kind of really seeing this disappearance of negative yields in Europe, and that may be seeing a little bit of a dampener effect now from what we've seen in terms of the rhetoric from the ECB, especially this past week.
So, Christine, I guess then the question becomes, what's going to be the next catalyst? We talked about that in the last hour in terms of the equity market. But in terms of higher yields in Europe and a stronger euro, what is the next step?
Well, Alex, what we're hearing from our sources, it is essentially a change in the mindset of the ECB. What they're looking for is for the ECB to kind of match this run-up in inflation expectations that we've seen in Europe, a little bit of improvement on the growth side as well, and of course the ramp-up in vaccinations. But all that kind of plays second fiddle if the ECB is still sounding very, very cautious in terms of their policy direction. And so until investors kind of see that coming from them and they actually believe that, then that's probably when we could see that next leg higher in bond yields. But until then, nothing moves in a straight line, of course. And from the commentary from the ECB this week, sounds like we're going to see a little bit of a breather in that run up higher in yields and the currency as well.
All right, Christine, thanks a lot. Really appreciate it. Bloomberg's Christina Aquino, who leads our FX bonds and emerging market coverage over in Europe. Joining us now for more, Marilyn Watson, a BlackRock head of global fundamental fixed income strategy. So a microcosm of that, Marilyn, are we going to see negative 40 basis points on the bund, or are we going to see zero first?
So I think certainly when we look at the ECB, when we look at the euro area in the total at the moment, in terms of the Bund, I do think we will continue to see yields track higher. As you mentioned before, there has been a lot of speculation around maybe some form of tapering, maybe the pace of the PEP program from the ECB in June. But at the moment, we think it's likely that they will continue the current pace going into the third quarter of this year. Think that there's still a lot to be digested by the ECB. We've heard from Philip Lane, we've heard from President Lagarde, that they're still very, very cautious around supporting the overall euro area. When we see, mobility maybe increasing a little bit, inflation is still way below the long-term target for the ECB. And so I think we will gradually see yields track higher in the Bund and in other, sort of areas as well. But I do think, there's still plenty of space for spreads to really compress if you look at peripheral Europe versus Germany. But that's really sort of more on the peripheral end. But I think overall, we do expect a gradual increase, but it's going to be pretty muted.
Maren, is the era of negative rates coming to an end in Europe, at least when it comes to the markets? We are negative 17 on a German 10-year at the moment. You talk about them tracking higher. It's not very far to zero from here. We were in single digits only a few days back.
That's right. I mean, it's not very far, and yet it seems like there's a huge gulf for it to really stabilize above the zero level into positive territory. I think given the huge shift that we've seen in the market, in monetary policy, and in the overall financial environment in Europe, then I really think that to see this whole shift in mindset, to see a shift in tone from the ECB, and to really see continued positive economic growth that's widespread and entrenched within the euro area, as well as to see, some maybe a little bit of increase in inflation in the euro area as well. I still think will take some time, and I don't think the mindset is there just yet. So I think at the moment the market's sort of settling in, so it's stabilizing a little bit. As I say, yields are tracking higher gradually, but I think we're now in a phase where the market's just sort of settling a little bit. We'll see what comes out of the ECB in June. And then from there, we'll see what happens as we go through the summer. We'll see what happens with, the economies that are a bit more open. If we look at Italy, Spain, areas that are very reliant on tourism, for example, I think really the summer will be key to show, what will happen later in the year in terms of the ECB.
So, Marilyn, if you wanted to play a better recovery and get ahead of that, where's the best value?
So as I mentioned, we are still long Italian government bonds. We still think there's some room to compress there in terms of spreads versus Germany. We also see that obviously Italy is going to be one of the largest recipients in terms of the recovery plan. But elsewhere, we also continue to like China. So we're long Chinese government bonds. We still think that there's very attractive carry there on a risk-adjusted basis. In addition, we like some other areas of local currency, emerging markets. And we do continue to have this barbell approach in terms of some investment grade and high yield bonds, very much on a sort of a bottom-up selective basis. And then we hold those positions which we think offer some value still and do offer potentially some price appreciation as well, versus a higher allocation to cash, particularly as we go into the summer and as we do look to see inflation tick up further in the US. We've seen the data up today already. As you do see the focus on the Fed and maybe the potential that at some stage they will start to discuss when they may start to taper as well, then we are still short duration in the US, and we do think that we'll continue to see tick up in the 10-year there as well.
Marilyn, what do you think about what's happening in the UK? The data certainly seems to suggest that the economy is accelerating, maybe faster than many people had anticipated. Do you think gilts are mispriced? Vliet today, Gertrude Vliet, out talking about the fact that maybe the Bank of England could be raising rates next year.
So we have been short duration in the UK, and we certainly felt that there was scope for yields to tick up further. We felt that too much had been priced in terms of a dovish Bank of England, and I think we're seeing that come through now. Also, in terms of the currency, we had a long position in sterling. We took a little bit of profit on that recently, but we are still long. And given the very, very rapid rollout of vaccines in the UK compared to other parts of the world, given the huge amount of stimulus we've continued to see from the government, the supportive stance of the Bank of England, then the data, has potentially maybe surprised a little bit on the upside, but we did feel that too much negative news had been priced in. And so, we remain short duration in the gilt space, and we continue to like the currency.
Before I let you go, Marilyn, I just want to get your take on what's happening in the repo market here in the U.S. Talk that yields could go negative due to some tactical constraints, et cetera. What do you think, and will the Fed have to respond in kind?
So, there's been a huge amount of debate about that recently, and certainly in the past few days, past few weeks. I think it's possible that you could see, further negative rates there, and that you may see something on the edge of the Fed adjusting technicals a little bit. Certainly, I think in June, again, when you get the FOMC meeting, you may actually see some adjustment around the edge. And that was actually the discussion at the last meeting as well. And that was something that we had potentially been looking for. Again, I think it's a very technical move, though. I don't think there's anything that's like deeply entrenched or fundamental, but you could start to see little tweaks. But overall, I think, as you say, it's nothing structural. And as we continue to see the market essentially try to normalize, then we will continue to see these little areas that need adjusting as the economy continues to get back into full strength and as we move away from this very, very loose monetary policy.
Marilyn, we're going to be there. Always appreciate your time. Thank you very much indeed for sharing it. Marilyn Watson, BlackRock Head of Global Fundamental Fixed Income Strategy. AMC up 20%. Year-to-date rally, 1,000%.
That's crazy.
Often, do you? It is pretty insane, isn't it?
Say it's bananas.
We're not going down that road. We're going to take a more conservative approach. We're going to be more Swiss about this. Alex, the Swiss economy firmly in focus. Apparently, we are going to see some pretty big risks emerging. Basically, it is walking away from its biggest trading partner, the EU, ditching a treaty that could have been signed. What impact is this going to have on Switzerland? What impact is it going to have on the EU? Nicholas Veron, Senior Fellow at Bruegel and the Pieces Institute for International Economics on this very subject next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Minutes past the hour. Let's talk about what's happening in Switzerland. Switzerland putting its ties with the EU at significant risk. Basically, the two sides have been working on a comprehensive economic treaty to basically replace the mishmash of treaties that have been in existence for quite some time that have allowed Switzerland to have free movement of goods and services and people. But now it looks like the Swiss have decided they're not going to sign the new deal. what impact is this going to have? Well, let's just talk about this in terms of trade. This is Swiss data I'm talking about here. This is from 2020. The EU, Switzerland is the EU's fourth biggest trading partner. There are huge amounts of goods and services that get transferred between one region and Switzerland, between the region that is the EU and Switzerland. Let's kind of break it down. So the US and China, certainly big parts of the customs data that we have. But if you look at Germany, huge. Basically, you think about the kind of four countries, the four large countries that border Switzerland. Italy, France, Austria's not on that list, Liechtenstein's not on the list, but nevertheless, this is a huge trading relationship that is being put at risk here, Alex. There are obviously comparisons to be drawn with Brexit and what is happening there, and you do wonder whether or not the EU is taking the line that it's taking with Switzerland because of the difficulties it's had dealing with Brexit. But this is a huge breakdown in terms of relations between Switzerland and the EU, and you wonder whether it could get worse from here.
Yeah, it's a really interesting story. So joining us now with more is Nicholas Ferran, Senior Fellow at both the think tank Bruegel and the Peterson Institute for International Economics. Nicholas, thanks for joining us. So in the stalemate that we're in has really deteriorated since that 2018 agreement. What's the next step now?
Well, as you just alluded to, things are going to get worse before they get better. And in a way, this is not surprising because there was increasingly an incompatibility between the dynamics of Swiss politics, which are very bottom-up, and with the refusal to delegate sovereignty to an external entity, which is the European Union, including in terms of judicial review mechanisms and things that are intrinsic to the single market. And what the European Union sees, I think, understandably, as the balance of rights and responsibilities which come with an integrated market. So that balance was fragile before Brexit. It was dynamic, it was in flux, but it has been disrupted by Brexit because, in a way, the EU can no longer afford to give the Swiss a special deals that would kind of paper over the tensions between their aspiration to sovereignty and the disciplines of the single market. So this kind of have your cake and eat it situation was no longer sustainable when it became the obvious benchmark for the Brexit negotiation. And I think this is exactly the situation we're in now.
Nicholas, how is this going to manifest itself? You talk about it getting worse. Where are we going to see this showing up?
Well, basically a number of market access provisions that Swiss companies and the Swiss economy currently enjoy are no longer going to be sustainable if nothing comes up as a breakthrough in the negotiation. And I think given what we've seen yesterday, we're not going to have a breakthrough immediately because I think the next step, frankly, is a very candid debate within Switzerland among the different components of the Swiss political system and society, including business, employers, employees, trade unions, and the political system, on what exactly do they want to achieve here. I mean, my view of the rejection, I mean, it was the Swiss party to the negotiations that terminated the discussion yesterday. It was a Swiss initiative, technically. I think this is going to create massive ripple effects in the Swiss body politic, and this will take time to work out through the normal Swiss way of having a collective conversation and trying to work a compromise.
Talk about the implications, Nicola. Is there another country that could be next in terms of their trade deal with the EU that could be the next to kind of deteriorate here?
No, Switzerland was really unique. And in the Brexit discussions, there had been, aspirations to following the Swiss model as if it was a model. But I think from an EU perspective, it's really a category of its own. It's a category of one. So I don't see a spillover to other countries at this point because frankly, the situation that Switzerland had in terms of single market access was different and better from all others in terms of, again, the balance of rights and obligations. So I wouldn't fear contagion. I think for Switzerland, it is a very difficult moment in terms of getting a sense of where their priorities lie collectively.
Do you think it'll have any impact in Brussels? Two large neighbouring countries now with very difficult relationships with the EU. Do you think that changes any thinking? Do you think that changes any tone coming from Brussels?
No, I don't think so. And I don't think there is a read across from the Swiss situation to the Brexit situation other than just removing what was, frankly, a fantasy. And every thoughtful person in Britain knew that in the last few years, that the UK could emulate the past arrangements of Switzerland with the EU. So that fantasy is gone, which is probably healthy for the British debate, but that's the only difference that makes for the Brexit situation. Let's keep the orders of magnitude in mind. The EU economy without Brexit, EU 27 is 5 times the UK economy. The UK economy is 5 times the Swiss economy. So these are the orders of magnitude we're talking about.
Good to get the maths right. Nicholas, thank you very much indeed. Nicholas Ferron, Senior Fellow at Bruegel and the Peterson Institute for International Economics. Still ahead, Alex, the world's most expensive car. Our interview with Torsten Müller-Ottwurst, the CEO of Rolls-Royce. We're going to discuss a new car, apparently for a US rapper. It's got a boat tail on it. Looks pretty cool.
So
we'll talk about that next.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Well, Guy, you were just mentioning this just a moment ago. AMC is up 20%. It takes the year-to-date gain to 1,000%. Sounds like a lot, and it is, but check out GameStop. That's up 1,200% year-to-date. It just shows like the meme, the Reddit crowd, they're still there. Even if they went back to work, they're still there. They're still in the stock market.
It's amazing to see the impact they're having. AMC, I did step up, did raise money, did take advantage of that situation, kind of ahead of theatres reopening. But as you say, they've come back for more. Absolutely sensational. What is the year-on-year gain now? Maybe it's just this year. It's like 1,000% or something.
For AMC, it's 1,000. It's 1,200% for GameStop. But what I also
These are crazy times.
What I also find really interesting is that, you know, it's also in Ford now, and I mentioned this at the top of the hour. Like, I'm not saying that AMC and GameStop aren't real companies, but I'm saying that Ford like makes stuff, you know, versus like a movie theater and a video game company. Like, I mean, and you have the Reddit crowd in that as well. I found that to be quite interesting.
Yeah, but Ford in some ways, you've seen what's happening in terms of the reopening of plants now. GM is going to be reopening some plants as a result of the chip story. But Ford is making a huge push into electrification. In some ways, from a sort of generational point of view, that kind of shift, I think, is fascinating, and kind of just feels more logical to me for a kind of generation that is looking at that. And we take it back to Exxon. You can almost kind of compare and contrast what is happening here, ironically, with the electrification shift that's happening at Ford, the new Lightning they're coming out with, and the troubles that Exxon are having. And the fact that they're being forced by their shareholders to make changes. I I just think what's happening in the market from a sort of societal point of view is fascinating.
Yeah, and we talked about that yesterday as well on radio, about the role that banks should play in society. I being with a customer yesterday about, you know, why did the bank CEOs get involved in the Georgia law about voting that was passed? And it's the differentiation of how companies need to be a specific kind of actor in society today. And it also speaks to maybe the role of the smaller retail investors, potentially the rise of sort of ETFs and sort of how that drives that change that we are seeing on a material level when it comes to some of these companies like an Exxon.
Yeah, and the Business Roundtable shifting from the purely profit motivation to the more stakeholder motivation as well. It's interesting how different companies are kind of moving in that direction. And I was fascinated when they were all asked, the bank CEOs, about unionization. Not everybody was on the same page there, were they?
Not so much. Was that when Jamie Dimon was like, no? Like deadpan, no. That was the one?
Straight up, no.
Straight up, no. But, you know, the point of unionization, that's a whole different conversation in terms of the wage pressure. But that conversation
but I think
it's
in some ways part of the same narrative, though. Anyway, European close is about to happen. Let's take a look at the final numbers as we go into the break, just to figure out exactly what is going on here. 3 minutes, 40 seconds to go. The DAX is under a little bit of pressure. Europe's kind of drifting sideways. The CAC Caron being lifted by Airbus. The close is next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Okay, we're wrapping up the Thursday session here in Europe. The close is almost upon us. Let's talk about kind of where we are. Boring morning, afternoon gets a little bit more exciting. We're not up by much, but we're up by 0.3%. You are seeing a difference in terms of the individual markets around Europe. as to what is happening here. FTSE, DAX, CAC, different narratives emerging. CAC Iran certainly having a good day. Airbus a factor behind that. We'll come back and talk about Airbus in just a moment. But let's show you what's happening. FTSE down by 0.2%. The DAX down by 0.2%. The CAC Iran is up by 0.6%. Now, one of the reasons why the FTSE might be a little bit lower is because some comments we got from the Bank of England a little bit earlier indicating maybe, and this is just according to one member of the MPC, that maybe rate hikes come a little bit sooner than maybe the market was anticipating. Let's show you what is happening with the pound. It has been moving higher throughout the day, certainly on the back of those comments, despite some concern, actually, from both the Prime Minister and the Health Secretary about the next phase of reopening. You can see the impact that had. Gertrude Vliho coming through with those comments. The pound up by 0.4%, 141.76. Pound up, FTSE lower. Let's take a look at the breakdown from a sector rotation and sort of narrative point of view, just to give you an idea of what is happening there. You've got basic resources, the miners are back on top. You can really see that. So Glencore's up today, Antofagasta's up, all the big miners trading strongly, despite those comments coming through from the Chinese. The banks are having a good day. The cars are bouncing back as well. Feels very much like that kind of cyclical value recovery story that we've been talking about. Travel and leisure actually having a fairly good day. Bottom end of the market, the bond proxies, they're down. This feels like a more positive reopening narrative in the markets today. Healthcare down, utilities down, the staples are down, the food and beverage, tobacco stocks are trading lower. Energy's down a little bit as well. In terms of the individual names, let's just talk about what is happening there. I mentioned the miners. Glencore leading the pack today, trading quite strongly. That stock up by 4.31%. Rolls-Royce, we've been talking about the car. I'm going to talk about the aviation company, the engine company, unveiling a huge test bed today. Basically, these are big pieces of kit. You bolt an engine onto them, a jet engine that is, so we're talking about significant stresses here, and you test what is happening with that engine. It's a huge piece of investment that the company has delivered, Warren East has delivered. There were concerns about it a few years ago. Brexit was certainly expected not to deliver this kind of infrastructure investment. Rolls-Royce has delivered upon that. It's going to have a meaningful impact in terms of its ability to generate the next round of engine technology. And kind of, it seems like a logical progression from one to the other, but look at Airbus. Look at what is happening with this stock today. The company is up by 9%. Basically, what it's announced today is that, or has kind of indicated to its supply chain, is that it is looking for a huge ramp, Alex, in its narrow-body markets, its narrow-body business. I'm not talking about the old C-Series here. I'm talking about the 320 family. They're converting the old 380 line down in Toulouse to produce 320s as well. And they're basically putting their supply chain on notice that they are looking to ramp up production. 2025, they could be up to 75 a month. That is a huge step forward. Could the supply chain cope? Are they trying to put pressure on Boeing? Are they trying to put pressure on Boeing's supply chain? All kinds of things happening here. But they have access to China. Europe's starting to come back. Global aviation is going to come back via the narrow bodies. And that really being priced strongly into Airbus today, Alex.
Yeah, super interesting. So let's get more on that. Bloomberg European Airlines and Autos reporter Sid Phillip joins us now. Hey, Sid, why do you think that they're doing this? Is it to put the screws to Boeing? Do they see some kind of recovery in demand that maybe other airlines and other airline suppliers don't yet see?
So it's actually a mixed picture, really, because for the airline industry, narrow bodies, especially in markets where they have large domestic markets, narrow bodies have actually been doing all right, especially in large domestic markets like the US and China. We're seeing demand actually coming back to 2019 levels. So the recovery is going to be led by the narrow body segment. And a lot of that is driven by the 320. I mean, the 320 series is among the best-selling narrow body series for passenger jets, really, at the moment.
Boeing's struggling in China. Airbus isn't. Is this part of that narrative as well, that it can basically see kind of China coming back in a big way, needs to be ready to be able to deliver upon that?
So for Airbus, it is actually a big thing to get planes delivered in China, especially since the MAX hasn't yet been certified in China. And given the fact that the Chinese market is obviously one of the world's largest, especially for domestic travel, Airbus will certainly be looking to capitalize on China. And as well as the fact that they do have a certain amount of sort of market share and orders. And remember, Airbus has a massive backlog of planes. And that sort of shows that Airbus is really willing to deliver those planes that it has on the backlog.
Hey, Sid, I'm going to ask a question about inflation, because we heard earlier that Elon Musk was looking into securing chip supply for Teslas further in advance. Is there anything to that here? that, they're going to ramp up and that's great, but that they also see supply shortages and higher prices and they want to lock that right in now so they can get the supply when they need it. What part of this is economic?
So actually, Airbus is really signaling to its suppliers that it needs to ramp up production, partly because before the pandemic hit, Airbus was struggling to deliver planes on time to its customers. And that was largely due to the fact that they had issues with supplies of multiple components, including engines at one point, as well as interior cabin fittings and everything else. So that's why Airbus is making sure that they can actually gear up. So when the recovery comes, suppliers are ready and don't really get bogged down by constraints on supply chain and everything else.
So what you should know about Sid is he's into the aeroplanes, but he's also into the kind of the motorbike and car story in a fairly big way. We talked to Rolls-Royce, the car company, a little bit earlier on down in Chichester. New car out today, 20 million, looks super expensive. You're not a fan.
Yeah.
I love it.
I think it's the motorcycle in me that it's sort of, I can't sort of get my head around the fact that I need a big, long car with so little purpose. I mean, a nice big motorcycle, especially an ADV, that gets the job done.
Sid thinks there's too much space there at the back. I think it looks really pretty. Anyway, we're going to hear from Rolls-Royce in just a few minutes' time. Sid, thank you very much indeed. Bloomberg Sid Philip. OK, so let's do that twist, Alex. From aviation to autos, we caught up with Torsten Müller-Ortfuss. He's the CEO of Rolls-Royce, the car company, a little bit earlier on. We started by actually talking not about the car that's behind him, but the semi-shortage that has hit so many companies in the auto sector this year.
We haven't seen anything. Obviously, we are part of the BMW Group, and I must say the BMW Group managed that chip topic extremely well due to the fact that they have ordered very early already sufficient amount. And we, as Rolls-Royce Motor Cars, haven't been affected at all because we also set our order books for chips early and ambitious enough to meet the demand which is now happening.
You have copyrighted Silent Shadow. And now I'm wondering what the transition to EV at Rolls-Royce is going to look like. When are we going to see that car? What is it going to look like? How different will it be to current Rolls-Royces?
I mean, that is still a secret, time to come. But it will, of course, obviously be a brand new Rolls-Royce, rest assured, no worries. But one thing I can tell you, it will not be this car, because we agreed with the clients that this is their car, and there are only 3 available of them. And we will not copycat that later into other Rolls-Royces or whatever. This is a truly exclusive design, and that was meant for the clients. It was even commissioned by the clients themselves together with our designers. So for that reason, that is protected. And the car you are talking about will look different, rest assured.
Will it be an electric vehicle?
Sorry, you broke away. Sorry, I couldn't hear that.
Will it be an electric vehicle?
It will be a vehicle, that's for sure, obviously, and but I can't tell you more that moment. Just one thing, we are sticking to our plans. I said it already. We will go definitely full electric in this decade and watch the space and see what happens.
That was Torsten Müller-Ortfuss, CEO of Rolls-Royce, speaking to us earlier today. So that was sort of what the new car is going to look like. But let's get back to that other one, because you can open up the front there or the back there, and there's like champagne that you can have. I mean, it's like a picnic thing where they only made like 3, right?
So apparently it's been made for an American rapper. The price tag around $20 million, I understand. Yeah, so this is a super expensive car. It's meant to, they're coming at a boat tail. So that does kind of go back to an era of time gone by. I think it looks better with the top down, kind of going for that Riva Aquarama kind of vibe. I think it looks amazing. I'm not with Sid. I think this car looks absolutely fantastic. I am, though, fascinated to see what the Silent Shadow looks like. That, I think, will be interesting, because kind of Rolls-Royces have that reputation for being silent, but everything's going to be silent soon.
Yeah, exactly. Also, further in the interview, we went on and asked about supply shortages. Like, as we mentioned, BMW did the chip shortage issue quite well. But one of the reporters pointed out that, what Rolls-Royce is known for are the little details, like the artisans, right?
Yeah.
And the supply, and what's going to be the issue there in terms of labor, in terms of that stuff, not the car and the wires and stuff, but the intricacies that make the Rolls-Royce look like that.
But is that going to be enough? And maybe they have an issue with the people to be able to do that. He didn't indicate that was the case at the moment. But is that going to be enough to make you want to buy a Rolls-Royce? Is that going to be enough if the car is already silent and it goes fast?
I mean, but do people really buy Rolls-Royces because they're like, ooh, it's silent? No, they're going to buy it because it has a picnic basket with champagne in the back, and you're paying 20 mil.
That's why you would buy it.
That's exactly why I would buy it. But, you're paying 20 mil, so it's a prestige thing. You're going to stick it in your garage and show it to people, and then go to the beach and be like, look at my cool back with the champagne, and then drive it back into your really fancy garage.
I agree. All of those things. If they're only making 3 of them, there is certainly a scarcity value factor that needs to be applied. Yeah. Anyway.
They're pretty.
Let's move on.
It was gorgeous. Yeah, move on.
Looks good. European stocks settling out. These are the final numbers. Let's take a look at where we finished. The CAC 40 certainly outperforming. We've already mentioned why. Airbus.
Coming up, Carl Icahn wants to get into crypto in a big, big way. I mean, I'll read the prompter. It's okay. More on that coming up next. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I don't see the direct lenders pulling back at all. In fact, I see them being a very important force, and we partner with many of them going forward. Yes, it's an extremely competitive environment.
Let's check in on the Bloomberg First Word News. I'm Rishka Gupta. President Biden is set to unveil a budget that would see federal spending jump to $6 trillion in the coming fiscal year, with annual deficits of more than $1.3 trillion over the next decade, according to documents cited by the New York Times. The proposal is expected on Friday and is said to show how the administration believes inflation, employment, and economic growth would be affected by enacting Biden's agenda. The Biden administration is taking steps to prevent ransomware hacks like the one that crippled Colonial Pipeline earlier this month. Directives will be issued as soon as today, requiring pipeline operators to conduct cybersecurity assessments and report any incidents to federal officials. Companies could face penalties starting at $7,000 a day if they don't comply. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Alex, Guy.
Hey, thanks, Ritika. Hey, guys, I just want to update everybody on some headlines that are coming out of Janet Yellen. She's testifying to the House right now. And she's talking about inflation. And she says that she sees inflation as temporary and not endemic, but she's watching the situation closely. She still sees a lot of slack in the economy. She sees high rates of inflation through the end of the year, but she still thinks that the U.S. interest burden is going to be manageable over the next decade. It feels like she's starting to sell that $6 trillion plan that Biden's going to unveil tomorrow.
Yeah, but as we were talking about with Mike McKee a little bit earlier on, if the US can grow faster, then it's not a problem. But current projections don't suggest that that's going to be the case. So if interest rates do rise and there isn't the growth that goes with it, then we've got a problem.
Yeah, exactly.
And she needs to be kind of crystal clear on what she sees happening here in terms of expectations. And she's basically pointing to transitory inflation, which would seem to suggest the Fed doesn't need to raise rates, though a few weeks ago she was talking about the possibility of rate hikes.
Yeah, I mean, a little taken out of context with that, but still, like, she should have known better to, like, stay out of that to some extent. Okay, so I'm trying to think of, like, a really fancy pivot here when you have, okay, big deficit, weaker dollar, devalue fiat currencies to crypto.
Okay, yeah, we'll go with that. Cryptocurrencies. Apparently Carl Icahn wants to get into them in a big way. Alex, he says they are apparently here to stay. He spoke to Bloomberg.
The whole concept of activism to get on the boards, and we've done it, as you know, innumerable times, and a lot of times successfully, some not successfully, to go in there and make changes. A lot of these companies have sort of hidden jewels in them. I mean, and the board of management don't want to do anything about them, and so they're laid to waste. So that is activism, really, going in. If you and find out you have assets that aren't producing enough, and you want them to do so and enhance value. So I mean, that's what it is.
Carl, it's important to add value right now when we have an economy running pretty hot. From your perspective, is the economy in the U.S. running too hot? What do you make of this inflation debate that, I mean, if Taylor and I had to take a drink every time we heard transitory, we wouldn't be fit for purpose right now in this role. How much are you currently thinking inflation is transitory or not?
Yeah, look, I really think that we're pumping a lot of money into this economy, and obviously you're going to get inflation from it. You already have it, so you have to be able to deal with that inflation, and you have to be able to put on the brakes, I think. Otherwise, eventually, we're going to hit a wall, but I don't know if that time is here yet. On a value basis, a lot of these companies are ridiculously priced, just ridiculously priced, and so eventually, you just can't have this without excess inflation, and so there's going to be a price to pay for it. Look, I don't think Reddit and Robinhood and all those guys are necessarily bad. I think they serve a purpose. Money is funneling back into companies. Some of these companies might be okay, but a number of them are really, the risk-reward is absurd. I go back to my example because that's my favorite one, because that's where I know a lot about. I mean, is where you're getting people, or you got people to support, for only 2% return, for instance, you got people to support, to sell insurance on these malls. I mean, it's an absurdity. And that's being done not by people you might criticize like Reddick. That's being done by Lawrence Bernstein. So it's really, we are really moving into certain excesses right now.
What would it take for you to be an investor in crypto?
Yeah, look, I think a natural manifestation of this inflation, it's not yet there, but you had it in the 70s. And what's going to happen if you have that is it's going to, a phenomenon of that is going to be for looking for other stores of value except outside the dollar, right? Because then just you know, we're a reserve currency now, but if you keep printing the money, it's not going to be there. Now, I'm not telling you that's going to happen for sure, and I'm not even telling you, I'm not telling you it will happen, but a currency like this cryptocurrency, well, you look at it and say, it really has no value. That's what the critics say, and I don't own any at this point.
So
but if you're looking for something where you might have another store of value, the criticism is a little bit, shall I say, wrong-headed when you say, well, what's the value of a cryptocurrency? Well, what's the value of the dollar?
Carl Icahn, Capital CEO, speaking to Bloomberg about crypto. We got there eventually, didn't we, Alex?
Interestingly enough, my segue made sense. From inflation to devaluing the dollar.
You coming out of Yellen, if we hadn't done the crypto bit, we'd be fine. We could come out of it and talk about crypto. Would have worked perfectly.
This is how we do the show,
But I think
guys.
his comments about what's happening with the dollar, I think, is really interesting. I think central bankers are increasingly aware that the risk this poses, and you've heard a number of central banks talking about this over the last few days. They can't lose control of this narrative, and I think that's what we're going to see over the next over the next period. Is greater and greater pushback against the crypto narrative. You saw it from the Danish central bank today. You've heard it from a number over the last few days as well.
Gary Gensler, the head of the SEC, testifying. We also may have bank CEOs talking about it, getting pushback, so maybe we'll get more of that today as well.
Yeah, they're going to be coming up a little bit later on. It's day 2, isn't it, on Capitol Hill. The bank CEOs were there yesterday, Senate today, it's the House. We'll be taking that live at the top of the hour. That's not very far away. But we'll give you a quick preview as to what day 2 looks like next. That's coming up. This is Bloomberg.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
Can we beat this to death?
Watch weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
How did we end up here where CEOs are making 900 times what some of their workers are making?
We're very proud of the opportunity we give to all of our people here. My compensation is set by the board. They look at multiple factors, and that's how it takes place.
My question, yes or no, will each of you set an example to every other company in America, companies that usually follow Wall Street's lead, by pledging to remain neutral if your employees want to form a union?
We would work with our employees to make sure that their voice is heard and do everything we can to ensure that that voice is loud and clear.
We would certainly be supportive of our employees having as many opportunities as they possibly can.
No.
We would allow them to have their voice heard and see what happens.
We'd allow their voice to be heard.
Like the others, we listen to and respect what our employees want to do, and we work with them in that.
That was, of course, Senator Sherrod Brown, chair of the Senate Banking Committee, questioning those Wall Street CEOs yesterday. We kind of truncated it, pulled it all together. Alex, the issue of unionization is going to be one that increasingly comes up. It certainly seems to be something the president is very keen on, the Democratic Party is very keen on. There was some fairly straight-up no's there, though, when it came to what is happening here. It's going to be interesting to see how this develops.
Yeah, and we were also talking about wages and unions earlier in the show as well. And if some of the bank CEOs don't like that, okay. But the idea that the power shift may be moving more in terms of workers, not just with banks, but with workers overall and unions, et cetera, then that makes you think maybe the Phillips curve is going to come back. Maybe it's going to come back in a more meaningful way, et cetera.
Okay, so what does day two look like? Bloomberg's Wall Street correspondent, Sonali Basak, is readying herself. Sonali, what are you looking for?
Yeah, I was just looking at the most recent numbers on forbearance, for example, because we know that lawmakers are very concerned about their constituents, whether they'll be able to pay back their mortgages and whether they'll be kicked out of their homes, right? A lot of these people are also renting. So a lot of that is very unclear across different state lines and regions. However, they want to know that the banks will be there for their customers at the end of the day at this late phase of this pandemic. Again, almost 3 million people across the country still behind on their rent payments. You were also talking about wages. That CEO to employee ratio has been a big concern.
100%, and closing the bank branches, et cetera. Sonali, thanks a lot. Busy afternoon for you, Sonali Basak. That wraps it up for me and Guy. Coming up, Balance of Power, Raj Cohen, Sullivan and Cromwell Senior Chairman, will be joining Balance of Power. And head over to radio here in the UK for the cable. This is Bloomberg.
With border closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
I certainly feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power. Today, the CEOs of the 6 biggest U.S. banks are going to return to Capitol Hill for a second day of hearings, this time before the House Financial Services Committee. We will bring you that hearing as soon as the question and answer period begins. But to set us up for what's likely to come today, we welcome now Ben Bain, who covers finance regulation for Bloomberg News. Ben, thanks for being with us. Maybe one way of looking at what's likely to happen today is look what happened yesterday and how different is it likely to be?
Yeah, thanks, David. I think that's absolutely right. Yesterday, before the Senate Banking Committee, you really saw two different universes, if you will. You saw Democrats clearly coming at this from the starting point of these bank CEOs and their institutions need to do more. They need to do more on climate change, they need to do more on diversity, and they need to pay their employees more. That was one of the themes that was repeated over and over again. And they also asked why more isn't being given out in terms of lending to underserved communities, particularly as a lot of these institutions had record quarters in the first quarter. On the other side of the aisle, you heard complaints about everything from focusing on social issues in terms of lending decisions and really just the Republicans asking banks to focus on making profits. So really you saw these 6 people up there, and they were really getting questions from 2 completely different stratospheres, if you will, and they were kind of fielding them different ways, and it was really interesting to watch. That's kind of where we are right now.
So Ben, we have the Republicans on Capitol Hill, the Democrats on Capitol Hill. There's also something going on at the other end of Pennsylvania Avenue called the administration. Are we getting any sense of where the Biden administration is likely to go in terms of banking regulation?
Yeah, that's a very good point. I think what we saw yesterday from the Democrats largely mirrors where the Biden administration is. There was a lot of talk about climate change. There was a lot of talk about doing more on social justice issues. I think that generally dovetails with where the Biden administration is. But there wasn't one theme that came out. There wasn't one threat of a new law, for example, to really crack down on some of these financial institutions. And I think that's probably a signal that the Biden administration also is not really seeing the banking sector perhaps as the area that they really want to crack down on, but more want to put pressure on, use the levers that are there and to further some of these policy goals that they have.
Okay, thank you so much to our Bloomberg colleague. He is Ben Bain. As we wait for that House bank hearing to get past the preliminaries, we welcome now the Dean of U.S. Banking Regulation. He is Rajan Cohen, Senior Chairman of Sullivan Cromwell. Raj, it's always a true pleasure to have you with us. You've been, I suspect, at or have watched more of these hearings than I care to imagine. But give us a sense of the larger significance here. What's really going on? Is this really likely to affect the behavior of any of these CEOs or these banks?
Well, David, first of all, it's a pleasure, as always, to be here with you. And I do think these hearings have an effect. They help the CEOs understand where the congressional priorities are. As Ben indicated, and I fully agree, those priorities are not the same for various members of the Congress, so there is a bit of a whipsaw effect. But yes, I think that these hearings do have an impact on the CEOs. They spend a lot of time preparing for them, and they spend a lot of time debriefing after them.
One of the themes from yesterday, really from both Republicans and Democrats, is how the banks are responding to so-called social issues. With the Democrats saying you may not be going far enough, the Republicans suggesting you shouldn't be taking that into account at all in making economic decisions. Is that something banks are in a good position to really address some of the social needs we have, whether it's minority businesses, whether it's employment and even labor unions?
Well, I think there are a number of areas where the banking industry has a strong commitment to assist. If you look at lending to minority communities, majority minority communities, low and moderate income communities, small businesses, particularly small businesses within those communities, rural communities, I think it is beyond doubt that the lending by banks, the availability of banking services has increased meaningfully in the last year or so. And some can argue not enough, even not nearly enough. But the bottom line as to results, I think, is irrefutable that there has been an increase. And the more that banking services are available to the less advantaged members of the minority communities, the better our country is going to be. And I think it's not a question of direct profit and loss, but it is a question of long-term viability.
Raj, to the outside world, there might be a bit of a tension here because we came out of the great financial crisis with a lot more regulation, a lot of concern about the banking system. We have Dodd-Frank. Is there potentially a real conflict or at least tension between, on the one hand, really upping your standards for lending and loaning to some of the people who need it most? Maybe by definition, some of those people who need it most don't have the FICO scores that really would support it.
I think it's possible to reconcile the two. I agree 100% with you. There is a tension, but there is a lot of room in a bank's balance sheet to balance risks. And so I think that tension can be resolved, probably not perfectly, but it can be resolved.
On the other side of it, some of the Republican senators yesterday were really suggesting that maybe it was inappropriate for banks to refuse to lend to some organizations, such as coal companies, such as companies involved in arms. Is there any requirement, or could there even be a requirement from federal regulators to say you must loan money to companies as long as what they're doing is lawful?
Well, there was an attempt by the acting comptroller of the currency at the end of the last administration to actually require such lending. That rule has been, I believe, permanently suspended. I think it is difficult to defend that rule as a legal requirement, certainly as it was proposed to be written. What banks are doing, I believe, are making judgments in the interests of their shareholders and constituencies. And if you suffer reputational damage, you may decide not to lend to a particular company or a type of company. That should not be, I think what some people are correctly saying, a political decision, but it should be a decision made in the best interests of the various constituencies that a bank is obligated to serve.
Raj, we're watching the CEOs as the hearings are just getting underway right now. The preliminaries are underway. And right now they're focused, obviously, on questions being asked them by, and today, Congress people. But if you're a banking CEO right now, what are you looking at from Washington, apart from these hearings? What are the issues that are most important to you as we go into the new administration, the Biden administration?
Well, let me take the issue which I think should not be front and center. And your earlier question to Ben really raised this, the absence of legislation to impose further what I would call safety and soundness requirements with respect to traditional metrics of safety and soundness like capital and liquidity, because the banks are well capitalized, have strong liquidity, and came through the pandemic in relatively good shape. So now turning to your question, what should they be focusing on? I would talk about the 4 C's. Cryptocurrency, which is a meaningful threat or an opportunity, I guess, depending on how you look at it. Second C is cybersecurity, which is obvious. The third and fourth you also mentioned, climate and the consumer, because the regulators are certainly going to be focusing on the latter 2, if not on all 4. And the banks, not surprisingly, need to focus on what the regulators are focusing.
Are the regulators deft enough to address some of those? Because cryptocurrency is moving almost faster we can keep track with. And for that matter, cybersecurity seems to be as well. Is there a challenge here for regulators to really, if not stay ahead of, at least catch up with what's going on in these new areas?
There is a challenge, and I think a number of regulators would acknowledge that they did not start quickly enough. But the regulators testified just before the CEOs, and they have formed what I think they called a strike force to deal specifically with cryptocurrency. You've seen the Biden administration EO on cyber. So it may not have started promptly enough, but I think there is a recognition that the government needs to respond very quickly.
Okay, Raj, as I say, it's always a great pleasure and privilege to have you with us. That's Rajan Cohen. He's Senior Chairman of Sullivan & Cromwell. And a reminder that we will be bringing you the hearing and the question and answer period begins. In the meantime, you can follow the preliminaries on the Bloomberg at Live Go. This is Balance of Power on Bloomberg Television and on radio.
Of interest to this committee that we will address today, including banks' wages for their employees and compensation for their CEOs, their youth.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
I think Bitcoin will be somewhere between 40 and 55,000 for the next chapter before it kind of builds up enough new momentum to take out that 55,000 and end the year much higher.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We are waiting for the House Financial Services Committee to begin its questioning of the major bank CEOs, which we will bring you as soon as it gets underway. That's the question and answer period specifically. In the meantime, the other big news in Washington today is that counteroffer from the Republicans on infrastructure, taking their number up to $928 billion, but that's still at least $1 trillion short of the latest offer from the White House. To take us through it, we welcome now Bloomberg Capitol Hill reporter Laura Davison. So the Republicans are coming toward the White House, but not too fast.
No, they've really taken some baby steps here as they've been trading offers back and forth. The White House last week put out $1.7 trillion. The top line number from the Republican offer today, was around $900 billion, but it's really only about $257 billion in new spending. The other $700 billion or so is money that would be spent otherwise, repurposing some stimulus money. So the two sides are really still quite far apart, though they do say they're continuing to talk. Shelley Moore Capito, the Republican senator who's negotiating on behalf of Republicans, she said Biden called her earlier today and has invited her to come to the White House next week to discuss further. We'll see, though there's some hesitancy from Democrats already in the Senate saying, hey, look, we should stop these bipartisan negotiations and go a partisan route. Dick Durbin, who's the number 2 Senate Republican, said, look, we should step away. And Senate Majority Leader Chuck Schumer said, we really want to do something by July. So that's really the new deadline that they're looking at, whether they do something with Republicans or they do something on their own.
Yeah, that's the critical question, whether they try to go alone or whether they want to do something bipartisan, which the president apparently wants to do. But I want to come back to that core point here, that in fact it's, what is it, $257 billion in what I would say new money as opposed to things already appropriated. How does that compare to the $1.7 trillion from the White House? Is that all new money, or is some of that repurposed as well?
That 1.7 trillion would all be new spending, would all be new money. So when you look at the difference, between 257 billion to 1.7 trillion, that's about $1.5 trillion apart. So they are not close in terms of how they're counting, how they're accounting for it, and how they pay for it.
$1.5 trillion. Sooner or later, you're talking about real money there. Thanks so much to Bloomberg's Laura Davison. For more on the infrastructure negotiations, we welcome now a member of the Senate Appropriations and Budget Committees, Republican Senator Mike Braun of Indiana. So, Senator, thank you so much for being with us. Great to have you here specifically on things like this because you're a business guy. You can do the numbers. We just went over with Laura. There's actually a bigger gap than we think between the two sides, isn't there? Because the Democrats want all new money, and that's not the Republican proposal.
No doubt about it. And I've been here just about 2.5 years, and we've gone from denominations before I got here of hundreds of billions that would have been a lot of money. I think back in the TARP days, what was it, 800 billion? And that was a real crisis. Here, I mean, 20 trillion in debt when I got here. We're going to be 30 trillion in debt soon, and maybe more than that. You're talking about infrastructure. At least they're talking about roads and bridges and rail and air and inland waterways, maybe rural broadband. But gosh, that's a lot of money, and you'll lose a ton of Republicans that are really conservatives when you're borrowing all this money as opposed to having a pay for. So we got a long journey to get there. It's the second most popular thing that I've seen being here in the Senate, probably next to funding defense for Democrats and Republicans generally. That generally gets most everybody voting for it. I don't, because it never has any budget considerations, never has any offsets. The Defense Department, and I think it's the most important thing we do, won't subject itself to an audit. That's not the way you run in the real world.
Yeah, so you've been there 2.5 years, which is 2.5 years more than I've been there. So give us some sense from the inside here. Is this a real negotiation where you think maybe they could come up with a deal, or is this more theater?
So a real negotiation would be if you're maybe 10% apart. Not nearly 100%. So no, I think there's been a big effort. You've seen it with the rescue bill that we spent, $1.9 trillion, borrowed every penny of it. Republicans were over there. You had this discussion coming from the White House, unity. We want to make it bipartisan. There was zero of that in that end result. Here it's a little tougher because every marginal $1 trillion you spend, I think it's a little tougher argument on the side of the Democrats and the White House.
At the same time, as you say, it's kind of a popular with the people to spend more money. Government spending money almost always is popular with the people. Let's go over to the other side of the ledger here, because we also have at the beginnings the outline of the Biden administration's budget, which we're told will be something like $6 trillion. I think I saw the number. It would run a deficit of something like 117% of GDP each year. Wow. Give us your reactions to that.
So if we're at $6 trillion, and I haven't seen it, I guess Bernie Sanders will lay that out in the Budget Committee at some point, coming from the White House. But that's unbelievable. Now that we are adopting maybe the modern monetary theory, I wrestled with Robert Reich on that in a Budget Committee meeting. What is your justification for it? Just because you feel no pain in the moment, it doesn't mean you can. He wouldn't even say that that was a theory that could base all this spending upon. So I think it's crazy. I think in building a business over the years, when you made good, sound decisions in the short run, tough ones, it was an investment in an easier life in the mid and long term. Completely reverse that in the bizarro world of the federal government. If it wasn't for the fact that we're the only reserve currency, interest rates at our historical lows, we'd be feeling a lot of current pain. And I think until the current pain is really felt, and I think it's going to be here sooner rather than later, nothing will change here.
So, Senator, we've been watching the banking hearings, first on the Senate side and now today on the House side, and they were asked yesterday, the CEOs of the major banks, about the deficit. Is it a real problem? And every one of them, as I recall, said, not yet, but it will be if we keep going this far. At the same time, and I want to be very respectful here, is that the pot calling the kettle black? Because after what we saw in the Trump administration with those tax cuts, they ramped up the deficit there, too. So are there any fiscal hawks left?
Only a handful of us. And the true measurement of that is if you like the policy will you vote against the bill because it doesn't have an offset, it doesn't have a pay for, and it's only borrowing from our kids and our grandkids. And yes, on the spending side, I think Republicans were just as bad as Democrats over the years. The unholy alliance is we roll over to get what we want on defense, give them everything on domestic spending. Sadly, that's only a third of our budget before, what Biden is proposing. Most of it is in Social Security, Medicare, and Medicaid. And we've known those programs were busting the budget for decades and don't have the political will to do anything about it.
Senator, I went back and looked at what happened in the 90s, at least the accounts of what happened in the 90s with President Clinton was they raised taxes, but they also cut some spending at the same time, which really helped the economy. I think most people would agree. Would you be open to something like that? We will raise some taxes, but we're going to really cut some spending at the same time.
Well, I'd have to see how much spending they're wanting to cut. It'd have to be an even trade. And if that happens, watch for pigs to start flying.
That's a little cynical. For 2.5 years already, you've got that attitude.
Remember, I spent 37 years running a business, watching this stuff evolve each evening when I'd get home. That's the reason I ran. We've only got a handful of us here that have ever been on a school board, probably a state government that balances its budget, but most importantly, run a business. And many here have probably never even run a lemonade stand, and that's why we've got the results that we have.
And that is one of the reasons we really enjoy having you on Bloomberg. Thank you so much. That's Senator Mike Braun. He's Republican of Indiana. And a reminder again that we will be bringing you the House Financial Services Committee hearing with the bank CEOs when the question and answer period begins. In the meantime, you can follow the preliminaries on Bloomberg at Live Go. This is Balance of Power on Bloomberg Television and Radio.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for a check on the markets while we wait for the Q&A portion of the bank hearing on Capitol Hill. Dave Wilson is here, and Dave, as I look at the equity screen, it looks like there's a little bit of green there.
Absolutely. I mean, the S&P 500's been higher all day. It's holding on to gains. It's really the industrial and raw material segments of the market kind of leading the way here. And when you go through the industrial stocks, you go right to Boeing and General Electric. They're at the forefront. You know, the common denominator is that France's Airbus, Boeing's biggest rival in plane making, decided it was going to increase production of its best-selling A320 jets. In fact, within 2 years, they're looking for output levels to be higher than they were before the coronavirus pandemic. Really triggered a rally across aerospace stocks, Boeing and, of course, GE with its jet engines benefiting from that move. Beyond that, automakers jump out. Ford Motor higher for a second day after increasing its investment in electric vehicles to $30 billion. And then General Motors saying it's going to reopen 5 plants that it had temporarily shut because of the chip shortage that's been affecting not only GM, but also the auto industry. You look at the financial stocks as we get ready for the second day of hearings, and they're higher pretty much across the board when you look at the KBW Bank Index. The money center banks, the Bank of America, Citigroup, JP Morgan Chase, Wells Fargo, all higher, and the regional banks with bigger gains. Smaller companies doing well when you look at the Russell 2000 Index. And there you go with the banks, the way that they're moving higher in today's trading. Russell 2000 Index also moving up, so smaller companies actually doing better than larger ones. And with the NASDAQ 100, it's kind of struggling a bit by comparison because you had disappointment with figures out of the dollar store chain Dollar Tree and also a couple of software makers, Workday and Okta. So, with Dollar Tree, it's all about, among other things, freight costs. They had a disappointing earnings forecast for the year. And we turn to the bond market, bit of weakness there. We're seeing yields move up as a result of prices falling. The 10-year Treasury at the moment, 1.62% yield, in the middle of the range where it's been since basically the middle of March. But something to watch as we move forward, David.
Yeah, it certainly is not going to that 2 that people were talking about a short time ago. So, David, as I listen to all that, there are a lot of idiosyncratic specific factors for different companies, even different sectors. But is it too simplistic to say that sounds like a reopening trade to me, what you just said?
Well, a lot of it is, no question, especially when you look at aerospace, because, we've seen air travel pick up already, and you'd figure that at some point, the airlines would want to buy more planes, modernize their fleets, if they've be in a position to do that. So, you're seeing that play out in today's trading.
Okay, Dave Wilson, thank you so much for that report. We'll come back with those hearings once they start. This is Bloomberg.
demand for WeWork space today is higher than it was prior to the pandemic. So what the pandemic allowed WeWork allowed to reinvent itself. It allowed to learn how to operate on a most cost-flexible basis.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We continue to wait for the House Financial Services Committee members to begin their questioning of the major bank CEOs. In the meantime, for Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. Republican senators are pitching a third version of an infrastructure counterproposal to President Biden. Senator John Barrasso of Wyoming was one of the lawmakers who presented the latest GOP plan.
This is something that can actually pass. What we're proposing today could pass in a bipartisan way. This proposal is fully paid for, does not need to have any raises in taxes, and avoids the big threat to the economy right now, which is inflation.
The president says he hasn't gotten a chance to go over the latest Republican offer, but expects a meeting with GOP lawmakers next week. British health officials say it's too soon to say whether the country can go ahead with stage 4 of its reopening of the economy, which is currently set for June 21st. UK Health Secretary Matt Hancock told Parliament today that the spread of the variant first identified in India could throw a wrench into the plan, saying he, quote, desperately wants to reopen the country, but he can only do so safely. Thailand's capital, Bangkok, is opening registration for COVID-19 vaccines to millions of residents today. The government is expanding vaccine eligibility to everyone 18 and older. Thailand reported more than 3,300 new cases today with 47 deaths. That's the highest single-day increase since the pandemic began. Total cases have more than quadrupled since April 1st. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. As we wait for the House Financial Services Committee to begin its questioning of the bank CEOs, one of the members of that committee, Republican Congressman French Hill of Arkansas, talked with Bloomberg earlier today. He started by talking about government spending and the debt.
We haven't seen this since the end of World War II, when America was 50% of global GDP, and that debt, way over GDP, was a result of fighting and winning a world war. Now we have embedded deficits for all the out years from our social safety net systems, and by government growing as a percentage of GDP, I don't believe it's sustainable, and my biggest concerns are the potential for creating inflation, once again going back to high inflation expectations. Secondly, the value of the dollar connected to that, obviously, and the ability of servicing that debt as interest rates inevitably rise from their historically below zero level today.
Other than winning in 2022, what is the appropriate Republican response to this budget as proposed? And again, I don't mean the one-year fiscal budget, Congressman, but the idea out 10 years. What's a cogent GOP response?
Well, look, starting in 2010 to 2019, before the pandemic, as you will recall, the budget for discretionary spending was essentially flat. In fact, it declined in real terms. So Congress has the ability to control discretionary spending and better reform our mandatory spending programs like Medicare and Social Security. And we need to come back to reality after the pandemic, Tom, focus our spending, target our spending, reform our mandatory spending programs, and in my view, as a House Republican, not expand the role of government in our daily lives, which this budget does in spades.
There is a question, though, about useful spending and the idea that sometimes if you spend, you generate more growth. We saw that certainly from the 1990s and the Clinton era. We've seen this over time. If you borrow, you can actually generate a more positive future. What is the distinction between good spending and bad spending right now?
Well, first of all, I think there's a rational level of spending too much, too fast on too many things that are not rational spending. And you look at the 1990s, President Bush and President Clinton had some modest tax increases, that's true, but you also had the peace dividend as the Soviet Union unraveled, and it allowed President Clinton to work with Congress to balance the budget by the end of the decade. And they did that through reform, including mandatory spending programs and other social spending. So again, it's targeting, it's reform those programs, it's look at ways to build our country. And when it comes to infrastructure, that would be a rational spending of public money. That needs to be done in a targeted way with a principal focus on things that are really in need of repair and reform.
Inflation has been an interesting debate, and that was one of the biggest arguments against running the deficit this deeply. A lot of people have come out and said they're worried about inflation. It's become a sort of polarizing debate in Washington. How much inflation are you looking at that would be too much? I mean, are you looking at specific thresholds that would create a problem for the economy?
Well, we have sharp increases in commodity prices. You look at lumber being the worst, perhaps, and Chairman Powell hopes that these are transitory. But other members of the Open Market Committee, like President Kaplan at the Dallas Bank, are concerned that if this gets out of hand, we will once again get into a 1970s inflation expectation situation, where instead of trying to cut costs and improve productivity at businesses, we just raise prices and suggest that up and down the supply chain, if we embed that, we're in trouble on inflation. If we don't, it's transitory.
That was Congressman French Hill, Republican from Arkansas, talking to Bloomberg earlier today. And a reminder that we are going to bring you that hearing as soon as they get to the question and answer period. Right now, they are still in the opening statement, so we'll bring that to you right away. In the meantime, if you want to watch those preliminaries, you can go to the Bloomberg and put in Live Go and follow them. This is Balance of Power on Bloomberg Television and on radio.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The major bank CEOs are still giving their opening statements in that House Financial Services Committee hearing, which we'll go to as soon as the Q&A begins. To help set the stage for what we're going to see, welcome now Sri Natarajan, who covers Goldman Sachs as well as Wall Street for Bloomberg News. So, Sri, thank you so much for stepping in here. You wrote some pieces in advance about what we could expect. Were you surprised by anything you saw yesterday in the Senate?
To be honest, not really. The setting is a virtual setting. You expected the politicians to go after the bank CEOs, but to a large degree, they managed to dodge bullets. The interesting thing here is, for these Wall Street CEOs, there really is no more safe haven. The Democratic lawmakers were going after them for issues on how much they've done to benefit minorities, how much they've done to help the working class. And you had the Republican lawmakers going after them for the policies that they have changed in recent years, their attitude towards funding fossil fuels or financing fossil fuel exploration, or climate goals, and even racial social justice measures. So wherever the CEOs looked, they were obviously facing fire. But for the most part, they managed to emerge unscathed yesterday.
Well, one of the things that caught all of our attention was that exchange between Senator Elizabeth Warren on the one hand and J.P. Morgan's CEO, Jamie Dimon, about the overdraft fees, where they really were going at each other, where essentially, as I understood it, Senator Warren was saying, we waived the fees for you from the Fed and you didn't waive them for your customers. And Jamie Dimon kept saying, well, we would have if you'd asked. Who had the better of that argument? Where does the truth lie?
It depends on your perspective totally, David, because this was one of the cases where you had Jamie Dimon, unofficially the captain of the industry, one of the longest-serving CEOs on Wall Street, and Elizabeth Warren, who's not made her dislike for Wall Street a secret. Both of them were talking over each other. That really was the only real moment in the 3 hours of hearings yesterday that there was some real fireworks. There was a lot of back and forth, but no real change. The problem for the Wall Street CEOs essentially is this: you've come through a year of the pandemic where vast communities across the world have really honestly been ravaged, but for the major U.S. banks, it was the most profitable year ever. They had incredible quarter after quarter after quarter. They come out looking really well, and for the politicians, that gives them a great platform to go after them and say that they're putting profits in front of workers.
One of the things I don't think I have heard that I sort of expected I might is, wait a second, you want us to make a lot more loans. What about you want us to make sure we got to keep our standards up? Because coming out of the great financial crisis, that's what you were concerned about. We'd been too profligate in our lending. Now you say we want to go farther. There's a danger we'll go too far.
That is the dichotomy here, because you have a situation where we've gone through a pretty severe financial crisis, and yet banks were not central to it. They looked healthy, they stayed healthy, and definitely came out of it better than they ever have been before. And on the other side, lawmakers want them to make more loans, and they will just go back to 2008 and say, at that time we were dinged for our risky behavior, so we are well served in being more cautious and raising our standards. And they also make the point that, frankly, there isn't enough demand out there, so what do you really want us to do?
Yeah, I see now we're to Brian Moynihan in the opening statements. We will go to the Q&A before the House Financial Services Committee as soon as it begins. But Sri, I understand you cover Wall Street. You don't cover Washington or Capitol Hill. At the same time, historically, there's a difference between the Senate and the House when they have these hearings. And it's not just in the number of people asking questions. The House tends to be a little more freewheeling in the questioning. What do you expect today?
Definitely more polarized remarks. Definitely expect some offbeat questions. It is obviously a greater number, like you pointed out. All of them have their own pet issues, and all of them want to use their 5 minutes to really drive home the point that they can take back to their base and say, we scored a win. So the CEOs certainly have to be ready for the unexpected. But if this hearing goes anything like yesterday, they don't have much to worry about.
Sri, I wonder, though, having watched this over the years, whether there's some effectiveness of this that goes beyond any specific legislation or regulations. We in New York have a tendency to say this is just a show, that, in fact, there's not going to be regulation, not going to be legislation that comes out. At the same time, do these hearings themselves have a tendency to shape the behavior of CEOs going forward? Because they know they'll probably get called back again in the future.
I don't know so much about shape their behavior going forward, but certainly shape their behavior going into it. We know in the week or 2 weeks or 3 weeks leading up to the hearings, all these CEOs had locked down, had tried to figure out, make sure that they get questions thrown at them from all directions, and they were ready to be, they were prepared for this. Go back to the financial crisis. Think about Lloyd Blankfein, the CEO of Goldman Sachs, for 12 years. The most remarkable image from his tenure that you think about is the inquisition he faced in the Senate. And all the CEOs who are going to be there today, all that they want to achieve today, and frankly even yesterday, over this 2-day period, is to ensure that they walk away without anyone remembering anything they said.
Yeah, exactly right. It sounds like a Fed news conference, actually. But Sri, to that point, there's a big difference between now and back in 2009, because actually, after having been through a terrible time for the economy a year ago or so, actually the economy is doing pretty well. As you said, these banks are doing well, but a lot of people are doing well too.
That is absolutely true. It's really going to be hard to find any parallel with what happened a decade ago. A decade ago, you could have looked at the banks and said, you were the source of a lot of problem, and look at the devastation that has caused. This time around, it is a virus. It is an uncontrolled virus. It is a pandemic that has swept its way across the globe. The banks are not responsible for it. The banks were in a good position. The banks were in a position to offer concessions to the consumers and still come out of it looking very healthy, looking very successful. The Democratic lawmakers would still tell you that you still need to do a lot more. What you did wasn't enough. And the fact that you're sitting on such a mountain of profits mean that you can do a lot more here. And that's where you need to focus your attention.
Okay, thank you so much, Sri. Really appreciate you being with us today. That's Bloomberg's Sri Natarajan. Once again, we will be coming back with the question and answer period of this House Financial Services Committee hearing when it occurs. Brian Moynihan, the CEO of Bank of America, is now wrapping up his opening remarks. And this is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David West, and the hearings have begun for the 6 major bank CEOs down at Capitol Hill before the House Financial Services Committee. We've had the opening statements from the chairman, the ranking member, and a couple of members of the committee, as well as some of the opening statements of the CEOs themselves. We're going to go live now to Capitol Hill in the middle of Mr. Charlie Scharf, CEO of Wells Fargo's remarks.
To do our part by working on solutions to tackle the problem of unbanked and underbanked individuals, and other efforts to foster an inclusive recovery. We look forward to defeating the impact of the pandemic together and believe Wells Fargo will play an important role to helping rebuild a stronger America. To our employees, I'm proud of the work you've done over the past year to support our customers and communities during these uncertain times. We've prioritized safety and well-being, and my deepest gratitude goes out to our frontline workers who made it possible to keep branches safely open. We transitioned more than 200,000 employees to remote work last March, and we understood the tremendous strain the pandemic would place on all of our employees and the families. We made special cash awards to approximately 165,000 employees, offered enhanced support for employees who are parents or caregivers, provided free voluntary COVID-19 testing for all employees working in a Wells Fargo location, and offered paid time off to employees. We offer paid time off to employees for vaccination appointments. For the communities we serve, we continued to invest in the institutions critical to their success. While we're very encouraged to be seeing signs of improvement, we realize that not all of our communities are benefiting equally in the recovery. That is why Wells Fargo has been working to support a more inclusive economic recovery with a focus on racial and social equity, economic mobility, and investments in low to moderate income communities. For example, we're investing in Black-owned minority deposit institutions across the country as part of our $50 million commitment to support MDIs. And we've given more than $150 million to CDFIs around the country. We're providing grants to hard-hit small businesses. Additionally, last week, we announced our Banking Inclusion Initiative, a 10-year commitment to accelerate unbanked individuals' access to affordable mainstream accounts and helped unbanked communities have easier access to low-cost banking. We are also committed to helping transition to a low-carbon economy and have set a goal of achieving net zero greenhouse gas emissions, including our financed emissions, by 2050. And finally, for our company, while we still have significant work to do, we are committed to devoting the resources necessary to operate with strong business practices and controls, maintain the highest levels of integrity, and have an appropriate culture in place. Thank you again for having me, and I look forward to answering your questions.
Thank you very much. Thank you very much, Mr. Schroff. Finally, we will go to Mr. Solomon. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairman Waters, Ranking Member McHenry, and members of the committee. Thank you for giving me the opportunity to speak today. These last 14 months have been an incredibly challenging time as the pandemic has swept across the world, killing almost 600,000 Americans and plunging us into a steep economic retraction. Even today, our hearts go out to the people of India and others around the world who continue to suffer from this virus. However, because of the swift actions taken by Congress, the Federal Reserve, and others to combat this health and economic crisis, I am optimistic about our future. As more people are vaccinated, the U.S. is poised for a very strong recovery. And I'd be remiss if I didn't thank Moderna, Pfizer, Johnson & Johnson, and AstraZeneca for the amazing work they and others have done on life-saving vaccines. The banking industry performed well during this crisis, as the Fed's 2 stress tests in 2020 confirmed. This is due in part to the Dodd-Frank Act and other financial regulations put in place since the 2008 crisis. Goldman Sachs remained well capitalized both leading up to and throughout the pandemic. Goldman Sachs has more than 40,000 employees, and I continue to be in awe of their resilience. To help them through the pandemic, we gave people an additional 10 days of paid family leave, expanded access to child and adult care, offered free telemedicine, and rolled out a global COVID testing regime. In addition, we've continued to pay our on-site vendor staff whether they worked or not. That includes our mailroom staff, cafeteria workers, security guards, and janitorial staff. Over the last year, we experienced historically elevated levels of client demand. And because we were well capitalized, we were able to help our corporate clients weather the impact of COVID-19 and position themselves for a post-pandemic recovery. For our digital bank customers, we launched a COVID Customer Assistance Program, which allowed customers to defer loan payments for 4 months and credit card payments for 6 months at no additional cost. We also found innovative ways to support small businesses. We are not an SBA lender, so we did not participate directly in the Paycheck Protection Program. Instead, we committed $1.25 billion in capital to community development, financial institutions, and mission-driven lenders who facilitated PPP loans across the country. The capital we deployed with our CDFI partners reached very small businesses, nearly half of which are in minority communities. The average loan size is around $43,000, and the median employee count is 2. In addition, last week we committed another $1 billion in partnership with the SBA and our CDFI partner Lendistry to fund approximately 40,000 PPP loans, over half of which will benefit minority-owned businesses. We did this to ensure these applicants were able to have their loans processed and approved before the PPP funds were exhausted. We also continue to support small businesses through our 10,000 Small Businesses program, launched in 2010. Through this program, we provide education by partnering with community colleges and greater access to capital to thousands of small businesses. Last year, we committed an additional $250 million to serve another 10,000 small business owners. We've also committed an additional $500 million to our program for diverse entrepreneurs, launched with GS. I now want to focus on three other initiatives that are incredibly important to us. First, we've already achieved more than a fifth of our 10-year target of $750 billion in financing, investing, and advisory activity focused on climate transition and inclusive growth. We've been carbon neutral across our operations since 2015, and we recently set a goal of net zero carbon emissions in our supply chain by 2030. Second, we commissioned extensive research on how to mitigate income inequality, which showed that Black women are one of the most marginalized groups in this country. It found that if we can reduce the earnings gap for Black women, we could see U.S. GDP increase by $300 billion a year. In response, we developed a new initiative called 1 Million Black Women, where we will invest $10 billion over the next 10 years to narrow opportunity gaps for at least 1 million Black women in the U.S. The final initiative relates to our diversity and inclusion. When I became CEO 2.5 years ago, I said this would be a top priority. Since I last testified before Congress, we have made progress. Our board will now have 6 out of 13 directors who are women and will be 62% diverse by race, gender, or sexual orientation. Our newest partner class includes the highest percentage of women and Black partners in our history. In addition, our 2020 campus analyst class in the Americas was 55% women and 11% Black talent, our highest ever. However, I'm not satisfied where we are, and we continue to work to address this. Thank you. I'd be happy to answer any questions you have.
Thank you very much, Mr. Solomon. I now recognize myself for 5 minutes for questions. I'm going to go to a question that I had not anticipated at this point because I wanted to talk about these low-cost homes. But let me just ask, we have, supported forbearance, and some of you certainly have been very good at doing that. However, we're getting a lot of concerns about homeowners, many of whom have lived in their homes for 15 and 20 years, and because of the pandemic, they found themselves with difficulty. They were laid off from their jobs, the jobs closed down, whatever. They could not afford to pay their mortgages in the same way that they had been doing for many, many years. And we had forbearance in the CARES Act, I believe, and also in the American Relief Plan. Now, that foreclosure moratorium ends around June 30th for those who have been into forbearance. I want to know from each of you, how many of you are going to offer these homeowners an opportunity for loan modifications, real loan modifications, that even if they don't know about them, are you going to initiate them? Are you going to deal with them in ways that will help save their homes and avoid foreclosure? Let me start right out with Jamie Dimon.
Yes.
Can you tell me whether or not you are going to employ the kind of operation that we won't have to get into a confrontation about, that we don't have to try and do something in law? You're going to initiate this program.
Well, I can't promise you that because I don't know the details, but we don't like foreclosing on people. We give modifications. We have plans. We'll work with everyone, and where appropriate, we will not be foreclosing on people. I do want to point out there are some appropriate where the homes are vacant, the people have been paying for years, they're vacation homes, they're second homes. So where appropriate, you can expect us to bend over backwards to help those folks stay in their homes.
Thank you very much, Mr. Diamond. I described the kind of homeowner that would be looking for a loan modification. I didn't talk about any houses that were boarded up and no one was there and all of that. I took an opportunity to describe that. I'm going to hold you to it. Let me go on to Ms. Frazier.
Thank you very much, Chairwoman Waters. We no longer service our own mortgages. We do so with partners now. We require that they follow GSE and federal guidelines on these matters, and we only work with people that have good best practices in these matters.
Okay, so you're going to be offering loan modifications. People don't have to, not know about them. You will be offering them. Is that right?
We will be ensuring that our partners provide that. Yes.
Okay, thank you, Mr. Monahan.
Chairwoman Waters, we have already modified a bunch of these loans, and the good news is a lot of them also have paid off through normal things. A lot of them come current. So yes, we'll continue to modify them. Because as Mr. Diamond said, the last thing we like to do is to take someone who can pay us through foreclosure.
Okay, thank you. I don't have time to continue on that line of questioning because I want to talk about not only the fact that the cost of housing is just escalating so much in my own state of California. You know, it's increased probably about 20%. And so it's very difficult for people to be able to get these down payments, et cetera, et cetera. But I want to ask you about these low-cost housing that's under $100,000 in some of these areas all across the country, small towns and communities of color in particular. They can't get loans from your banks, they tell me. I ask you to submit some information on that. Most of you did, but how many of you are absolutely committed to taking a look at this market and understanding that this is a way by which people in low-cost housing can become owners if, in fact, they can get the loans from you? I'll go back to Mr. Diamond again.
You raised a very good point with us a couple of days ago, and we are going to dig deep into it and see if we can come up with programs that work.
Ms. Frazier?
Exactly the same, Chairwoman Waters.
Okay, Monahan?
Chairwoman Waters, yes, we are going to take a look at it. You raised a good point. And as we enter some markets with lower cost housing, we probably will be doing more of them anyway.
Mr. Sheriff?
Chairwoman Waters, we do a significant amount of loans under 100,000. We will absolutely look to see if we can do more.
Okay, and I suppose Gorman?
It's not really a business, Chairman Waters, that we're in. We only did 7 loans this year of that size.
Okay. All right, thank you. My time has expired, and I can't get into this any deeper, and I yield back the balance of my time, and I will now call on our ranking member. You have 5 minutes.
Thank you, Madam Chair, and I want to thank you all for being here in this format. And as I open, this is a sequel that no one asked for. The hearing 2 years ago, I don't know that much was learned. We're going to have a similar issue set, but modified by the political discourse of the day. And so, I think of this as an opportunity for me to ask you important questions about your insight into the economy. We know that through the financial crisis, the banking sector it provided important liquidity and played its role in our economy to ensure that lending was possible, that smart underwriting and lending was still possible in the midst of a pandemic. So I think that is commendable work that your institutions and banks and fintechs and credit unions put in during the financial crisis. The question I have for the whole panel is to have the outlook on jobs going forward. We had 8 million unfilled jobs last month. 8 million unfilled jobs. We had 266,000 net increase in employment, but 8 million jobs unfilled. There's a lot of debate in Washington about why that's happening. I'd like to hear from you as experts on the economy about the nature of that. So if we can begin with you, Mr. Scharf, and then you, Mr. Moynihan.
Congressman, I'm not sure I have a great answer as to why it's the case. What I can tell you is what we hear from our clients and what we see ourselves. And what we see from our clients is that their confidence is building. And they feel very, very good about the prospects for the second half of the year. Debt levels are down on a corporate basis.
But how can you have economic growth if you can't get people to go back to work? That's the fundamental question. Let me move on to you, Mr. Moynihan. Same question.
Our small business customers, we just completed a survey, and that the issue raised has come up to the highest level of all the issues. It was a pandemic, obviously, 6 months ago, and now it's turned to getting workers for the jobs. I think it's a serious concern, and I think that the states and others I talk to are trying to put money to work to train people, and I agree with you. It's if you think forward about the risk of the economy, it's the inability to get stuff in through the ports, and it's the ability to get people to work back to work in a fashion now that the economy is opening up.
Ms. Fraser and Mr. Diamond.
Yes, I think we're seeing significant dislocations as the economy normalizes. One of the pieces that will be critical is as the savings go back to work and as liquidity that is sitting out there at the moment gets translated into ways that create more employment and new business creation to drive the recovery.
Mr.
I think, Ranking Member, I think the reasons are manifold, including some of the unemployment insurance, including the fact that our schools haven't reopened up, and including the fact that people actually have a lot of money and they don't particularly feel like going back to work. But I think you should rest assured, I think we're going to see a completely booming economy. A lot of people are going back to work, and hopefully it will continue for quite a while.
Well, thank you. Thank you for answering that, Seth. Now I've got questions about on the international front. We see a lack of transparency associated with China's lending across the globe. China's resisted international standards set by bodies such as the Paris Club and the OECD arrangement on officially supported export credits. We see this globally. Moreover, we see the Federal Reserve has flagged elevated debt levels in China, high real estate valuations, and weaknesses in their financial sector. And what I see is a lack of transparency in their lending and a lack of transparency internationally to their domestic actions. Can you give me further insight into this, and how can how should we believe China? And do you believe that China's lack of transparency and its official financial sector vulnerabilities pose a potential risk to global financial stability? Mr. Solomon, that question is for you. Then to you, Mr. Diamond.
I appreciate the question, Ranking Member McHenry, and I think you phrased a bunch of issues that are issues that we spend a lot of time thinking about. Transparency in markets is always extremely important, and more transparency is better. I think that we understand that we operate in a very globally interconnected market, so that the degree that some of the issues you highlight do become issues that have an impact on China's economic activity, we'll certainly feel it back here in the United States and can have a contagion effect. I don't see that at the moment as a likely issue, given the recovery they've had coming out of their pandemic, but I think all these things are things that should be watched and observed closely.
The gentleman's
Well, Mr. Diamond, I think you were saved by the bell, and thank you all for testifying.
The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, for holding this hearing and standing up for consumers, and thank you to the panel for participating. I want to follow up on the questions from Senator Warren about overdraft fees. President Obama signed into law My Credit Card Act, a bill I wrote to end the most abusive practices of the credit card industry. According to one study, this bill alone is estimated to have saved consumers nearly $12 billion a year. A 2015 CFPB study estimated that it saved consumers $16 billion in the first years of its enactment. But where we made great progress on stopping abusive practices in the credit card market, there is still much work to do on banks' overdraft practices. I plan to soon reintroduce my legislation, the Overdraft Protection Act, to crack down on unfair predatory overdraft fees. Bank overdraft fees are outrageously priced, predatory, and beyond the scale of what a reasonable charge should be for this service. And we know that these fees and practices are harming consumers and taking billions out of their pockets. According to an S&P Global Market article from earlier this year, the larger banks collected $8.8 billion in overdraft fees alone and reported over $147 billion in net income in 2020. Making these practices even more egregious, overdraft fees hit those who can afford them the least, the hardest. Those who are trapped are often cash-strapped, hardworking Americans and college students who are struggling to pay their bills. And so that $8.8 billion collected last year is money taken out of the hands of Americans who are trying to just keep food on the table and stay afloat in the middle of our pandemic. Each bank has slightly different policies, making this even more confusing to consumers. All of your banks basically charge around $35 for each overdraft. But the worst of these fees can be on debit card transactions, where the overdraft averages $20 but comes with a $35 fee. Multiple transactions can quickly add up to where a consumer is charged well over $100 in fees alone. So let's focus on Wells Fargo. Mr. Sheriff, neither Citi nor Bank of America charge overdraft fees on debit card transactions, apparently deciding this practice was not in the best interest of their customers. I find it curious, why has your bank made the opposite decision, seemingly thinking a sandwich or a cup of coffee at a deli should result in a $35 overdraft fee if they can afford it?
I'm sorry, are you finished?
I'm waiting for your answer.
Congresswoman, we are constantly looking at ways to be more consumer friendly. We introduced an account last year which has no overdraft fees at all. It's actually probably our most popular account since we've introduced it. And so we have options that are readily available for customers who do not want to overdraft. We also offer overdraft protection and something called overdraft rewind for those that aren't account that can overdraft, which allows us to look back 24 hours for a direct deposit coming into that account. And so these are things that we've added where we're looking to become more consumer friendly, but it's certainly something that we will continue to look at.
Well, when did you introduce you have an account that has no overdraft fees?
We introduced
I would
it.
think that everybody would take that one because I don't think many people want to pay $35 overdraft fee for a cup of coffee. When did you introduce the program that has no overdraft fees?
We announced it approximately a year ago, and I believe we've had it in the market for probably 6 months or so. I'll get you the specific dates.
And how do you inform your customers that they can have this option of not having any overdraft fees?
It's part of the suite of products that we talk to our customers about on a very regular basis.
Well, it seems like I would think everyone would choose that if that was really possible. I think everyone likes a good sandwich and a cup of coffee, but not at a cost of $40 or $50. And I feel that these fees are unfair, unaffordable, and unreasonable for all Americans, plain and simple. Let me ask you, Mr. Sheriff, do you think a $35 fee for a $6 debit charge is reasonable?
The gentle lady's time has expired. Would you please get back to Ms. Maloney to answer that question? With that, we're going to go on to Ms. Wagner from Missouri. You're recognized for 5 minutes.
I thank you, Madam Chairwoman. And I'd like to also thank our witnesses for being with us today. It is important to me that public companies, such as the ones that you all lead, continue to focus less on political agendas and more on what will benefit your investors, your customers, and your workers the most. That is maximizing profits and shareholder value. I'd just like to say that up front. Mr. Moynihan and Mr. Diamond, this is for you. The Biden administration has proposed an increase in the tax rate as high as 28% for American businesses and industry, along with many other tax increase measures, all to offset an additional anywhere from $1.7 to $2.3 trillion in government spending. How would an increased rate impact your ability to support our economic recovery, and what sort of burden would American workers and small businesses bear? I'll start with Mr. Moynihan's response first.
Thank you for the question. I think starting with your point about what our customers tell us, our small and medium-sized businesses, of which we have many, are worried about tax increases, not slowing down their ability to invest in their employees, invest in new equipment, be competitive, because many of those small businesses supply into the supply chain for the larger companies in this country. And so their concern is about that. When you go to the larger companies, an increase in taxes is a couple things. One is their fear is that it'll lead them to have to put more capital available outside the United States because frankly, the final demand, the globalization economy provides opportunities that weren't here 30 years ago. And I think they're concerned about that. They're also concerned about the impact of prices coming into them from suppliers. So, I think that's what's on the minds of our customers. And I know that there's a lot of work going on in this body and other bodies regarding the merits of all that, but that's what we hear from
Thank you. Thank you. I appreciate it. Mr. Diamond, briefly.
Yeah, so the Biden tax number has taxes going from 21% to 28%, which is halfway back to what we think we had in 2017 before the last tax act at 35%. But the tax increase is actually 4 times what the tax decrease was from 2017. Because you all know the phrase, devil the details. Well, the details here are all that matter, not the top line of 28%. I've always believed that we need, if you want to have a healthy, growing, competitive America against the rest of the world, you need a global competitive tax rate, because at the margin, capital will be retained and invested overseas. The same capital you want retained and invested over here. So I think it would be detrimental to a lot of, I'm not worried about banks per se. It'll be detrimental to a lot of companies. It will push a lot of capital overseas. It'll be unfortunate. There are better ways to collect taxes that would do less than that. And
it would hurt the customers and the clients that you serve every single day. And we must also remember that 55% of small businesses organized as a C Corp. So real quickly, one answer fast. Would an increased rate allow your firms to be more or less competitive globally? Mr. Moynihan. More or less competitive.
I'm sorry. An increased rate could lead to less competitiveness globally. Thanks.
Mr. Diamond.
It would be less competitive, and that'll get increasingly worse over time.
Thank you. Mr. Diamond and Ms. Fraser, would you describe the challenges your firm faces in terms of global competition? Specifically, how does China factor into those challenges as a global competitor? I'll start with Ms. Fraser's response, please.
Oh, thank you very much. China is playing an increasing role in the global financial system. And I think it's very important that for serving American multinationals abroad and indeed the US government and other entities that the important flows of foreign exchange, trade, cash management, and indeed the access of global investors, the US market happens on American rails and not on another countries. I think it's of strategic importance for our multinational companies and those working abroad.
Mr. Solomon and Mr. Gorman, discussions around a financial tax transaction tax have increased over the last several months. I'm concerned about the harm that this tax would do to our Main Street investors saving for college or retirement. What adverse effects would this type of tax create within our financial system? Mr. Solomon, and I have very limited time.
It impacts investors, and it would impact investor activities, Congresswoman.
If I could, Madam Chairman, I've run out of time. I would ask for Mr. Solomon and Mr. Gorman to send me a written response, if they wouldn't mind, to the concept of this financial transaction tax. And I thank you, and I yield back.
Thank you very much. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Businesses, now recognized for 5 minutes.
Thank you, Madam Chairwoman. Mr. Diamond, I would like to address my first question to you. In addition to being a senior member of this committee, as mentioned by the chair, I am also the chair of the House Small Business Committee, which has primary jurisdiction over the Paycheck Protection Program. Despite making several changes to the program between the first tranche and the second tranche to make it easier for LMI small businesses to access funding, and including a specific set aside for borrowers located in LMI areas. The number of PPP loans issued by JP Morgan community in LMI communities actually decreased. In round one, your bank issued approximately 58,000 loans to LMI small businesses, while in round two, you only issue approximately 14,000. Can you explain this decrease?
Well, we're the largest lender in PPP. We lent as much as we can, everywhere we can, according to government guidelines. 90% of the loans in the first round went to companies of less than 20 employees, and we reached out everywhere to LMI communities and stuff like that. I'll get the exact numbers, but I think we did a fairly good job at it. And
well, I do have the numbers. I do have the numbers. I do have the data because I'm the chair of the Small Business Committee and working with the SBA. In fact, we held a hearing yesterday. So my question to you is, when we're talking here, that despite the fact that we set aside for just lending to LMI small businesses, not only did your bank decreased the number compared to the first tranche and the second tranche, but also the size of those loans. It went down from approximately 117,000 in round one to 80,000 in round two. At the exact time, we all knew that small businesses in LMI communities were starving for capital. And despite how hard they work at applying for those loans. So it doesn't seem to me that your bank was doing everything it could to reach these businesses.
Well, we did, and we reached out everywhere we can. There was less demand. The second program was smaller. And then we went out in other ways too. We lent $70 million. We invested $70 million in MDIs. We invested in some of the Latinx banks. We reached out to CDFIs. We begged them to help us find more people. So we did everything we could reasonably do, and we always try to do the best we can.
Well, sir, the numbers showed otherwise, and those numbers change in LMI communities when we worked and brought in mission-based lenders such as CDFIs, CDCs, micro lenders. So I hope that we can do a better job in reaching out to those businesses that are starving to get access to capital. Ms. Fraser, when we held this hearing 2 years ago, I questioned your predecessor on Citigroup's CEO pay ratio, which was the largest of any bank testifying that day, a remarkable 486 to 1 ratio. Can you explain how you're working to reduce this ratio? And in your explanation, can you discuss not only the CEO side of the equation, but the median employee compensation side as well? Ms. Fraser?
Can hear you, Jane.
Sorry, my apologies. Thank you very much for the question. Yes, I want to start by saying we completely appreciate how fortunate I am for the compensation that I do get as the new CEO at Citi. We want to make sure that our employees have a fair, competitive wage, that they have the opportunity to grow inside our company, provide them development opportunities, and also to provide them the different benefits that they need to support their families and for all the challenges during COVID and beyond. So the different things that we're looking at are the programs that we can put in place to support our employees' growth in their compensation going forward.
I yield back, Madam Chair.
Thank you very much. The gentlelady's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. As the largest financial institutions in the country, You extended $8.3 trillion in credit last year, which is a testament to your ability to advance our economy. I'm very thankful for that, quite frankly. However, when you all decide to boycott industries, you use your size and power to put companies out of business. What's worse is that these decisions clearly are not made as a matter of conscience. Your investments in China prove that. These decisions are being made to pacify political activists who want to do what the law cannot do, which is shut down legal American businesses. By complying, you are no longer supporting our economy, but actively working against it, I would argue. To that end, there's a report out that all of you have put out, the Environmental, Social, and Governance Report, where you publicly claim the actions of your banks in these different areas. 5 of the 6 reports that your institution specifically mentioned moving away from coal financing and investing in other things. There's an article just recently that came out in Bloomberg titled Goldman City Lead U.S. Banks Plowing Billions into China. Specifically, JP and Citi 21 billion, Goldman 17 billion, B of A 13, Morgan Stanley and Wells Fargo 4. To that end, it's worth noting that the ESG reports condemning the coal industry, only Goldman mentioned China in terms of carbon emissions. Ms. Fraser, quick question for you. Is coal and drilling for oil and gas, is that illegal?
No, it's not illegal.
Are you taking similar actions in China to what you're doing here in the United States by boycotting specific industries and putting pressure on companies to change their business model?
We are supporting the clients that we serve, multinationals and local companies, to make the transition to lower carbon technologies, mindful that different industries are at different stages of doing so.
So you're probably not, is that what you're telling me?
Correct.
Okay, Mr. Foreman, Morgan Stanley, they've got about $4 billion. Same question, is mining coal and drilling for oil and gas, is that illegal?
No, it's not.
Are you taking similar action in China that you're doing here with boycotting specific industries and putting pressure on companies to change their business model?
We continue to support existing coal businesses around the world. We're not financing new coal businesses in any country in the world. It all goes to our franchise committee.
Thank you for that. In addition to the ESG reports, each of your institutions have published statements on human rights which include actions your companies are taking to improve human rights around the globe. I want to point out that not one of your statements on human rights mentioned China. Not one single company mentioned China in your human rights statement. The State Department has a statement out with regards to what's going on in China. It's widely reported the kind of religious genocide that's going on, the horrible torture and other things that are going on with minority religious groups over there. And now even the administration in the last couple of days has acknowledged that the development of the COVID virus at Wuhan Labs is going to go after that, which is done obviously for nefarious purposes. Mr. Solomon, you've been in China since 1994, have a 17 billion in investments there. Do you intend to alter your business in China as a result of these human rights violations?
Well, first and foremost, Congressman, I appreciate the question. And first and foremost, we're an American company, but we operate on a global basis. I think the bilateral relationship between the U.S. and China is incredibly complex. There are places where obviously we cooperate, and there are places where we're confrontational. We try to navigate that in an appropriate way and stay engaged with our clients around the globe.
So is the lure of profits that great that you will turn your eye to the human tragedies and sufferings that are going on in China by their government and the Communist Party, which is one and the same, which is who you deal with for the last almost 30 years here?
We, I think, look at this broadly as a complex relationship. I saw recently that Secretary of State Blinken said that we have to at all times be competitive, collaborative, and adversarial. We try to operate. Our clients, our U.S. companies that we serve, Congressmen, are operating in China, and we try to serve them in that context. We think it's better to stay engaged than not, but we'll follow very closely what you all do as legislators in terms of how U.S. companies should be engaged around the world, and we take that very seriously.
Mr. Diamond, would you like to answer the same question? Do you intend to alter your business in China because of these human atrocities that's going on?
So we operate in over 100 countries, and we operate under the law of the land in each of those countries. And under the law of the land is the Communist Party law? But we follow the foreign policy of the United States of America, which is your policy. So we follow engagement.
Foreign policy in this country,
and when you tell us
was to get out of China.
And when you tell us not to, we don't. Like Cuba, how we do business with Russia, we follow exactly what you tell us to do because we're patriots, just like the rest of you in this call.
Well, I think the previous administration
time
getting out of China, cutting trade ties, and getting the trade deficit down. Thank you very much. I yield back.
The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
In 2008, the financial system caused a horrendous crisis that devastated our country. Democrats responded by changing the regulatory system, particularly Dodd-Frank. Now the financial system has survived the greatest stress test that I could have imagined. It did not cause this crisis, and it has shown resiliency during this crisis. That's in part because of the regulatory changes that we made, and in part because of the stewardship of some of the executives that are before us today. We now face another systemic crisis. It's certainly not of the same level of COVID, and that is LIBOR. We can solve this in advance and avoid the problem. My colleagues have heard me talk about this again and again. We have several $1 trillion of instruments outstanding, where next year or into the following year, you will not be able to calculate the amount of interest that is due because they're tied to the LIBOR rate that the folks in London will no longer publish. So I'll ask each of you, and I'm going to ask you to answer in one word. Do you feel that federal legislation is warranted to deal with the financial and legal fallout that will occur if we don't have a replacement rate for LIBOR? Mr. Diamond?
Yes.
Ms. Frazier?
Absolutely, yes.
Mr. Gorman?
Yes.
Mr. Moynihan?
Yes.
Mr. Scharf?
Yes.
Mr. Solomon?
Yes.
Thank you. Mr. Solomon, Archegos put a light on total default swaps in family offices. We haven't had in this country a limitation on margin lending. You have to put up half the money, and that has been the rule basically my entire long lifetime. But we saw the Archegos family office get 9-to-1 leverage by using the total return swap. And so my question is, should we allow the average Robinhood investor to get 9-to-1 leverage? Should we prevent Archegos and the other well-connected and wealthy institutions from getting more than 1-to-1 leverage by banning the total return swap and similar devices? Or should we have one rule for Robinhood and another rule for the Sheriff of Nottingham and his family office?
So I appreciate the question, Congressman, and I think that this is an area that I know people are looking at closely, and I think it's probably a good thing to continue to look at it. I think the big thing I'd focus on is transparency, and I think one of the things that would be interesting is to update the disclosure regime around the different and more modern ownership exposure.
I asked a question. It's now very transparent. If you're a Robinhood customer, you get 1-to-1 leverage. If you can negotiate a total default swap because you're big, you can get 8-to-1, 9-to-1 leverage. That's transparent. The question I asked you is, should we stop it? And your response has been, well, we should disclose it. My question is, should we have the same rule for Robinhood as the Sheriff of Nottingham in his family office?
I think when you look at institutional participants in markets, there are a variety of ways where people can get leverage that's more than 1-to-1. Generally, for just straight stock ownership, straight up cash stock ownership, whether retail or institutional, if you're looking at straight margin, Reg T margin rules, it is 1-to-1. Generally speaking,
obviously reclaiming my time. The total default swap is a way to have all the economic benefits of stock ownership and evade the rules. I'm going to try to squeeze in one more question for Mr. Sharp, and that is, we see that $1 trillion of federal taxes go unpaid by the top 1%. Secretary Biden President Biden has indicated, along with his Treasury Secretary, that to collect that, we need more reports from banks. If those are legally required, are you prepared to cooperate and not only disclosing the taxable income, but the transactions required?
Congressman, we will do whatever is legally required.
Thank you.
Thank you very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. 40 years ago, as a young man, I was trying to get into the farming business, and I went through the inflationary period in the late 70s and early 80s. Very exposed, operating in debt, interest rate controls had gone off. It was a wild ride. So that brings me to where we are 40 years later. Over the past several months, we've experienced a surge in commodity prices: crude oil, natural gas, corn, soybeans, wheat, materials like lumber and cotton. What do you believe has been driving this rise in prices, and do you expect this to be sustained for some time to come? And I'd first like to turn to Mr. Solomon and Mr. Gorman to weigh on this, if you would, please.
Thank you, Congressman. I appreciate the question. It's certainly something that we've been spending a meaningful amount of time thinking about. I think there are a number of factors that have been affecting commodity prices, and I think as you stand back and look, the shutdown of the pandemic and the dramatic contraction of the economy had a profound contracting effect, and now we're opening up very quickly. And so we have the combination of demand picking up very quickly and supply production and availability and supply chains and distribution chains not being as full as they would normally be. That's obviously leading to inflation in prices. I think what's hard to see at this point is whether or not it's going to be transitory or whether or not it will continue or be more sustained. I do think it's something to watch very carefully, and the speed of the recovery combined with other fiscal actions or monetary actions we take will obviously have an impact on this. Hopefully the Fed can manage appropriately as we go forward in what's obviously going to be a strong economic pickup from a demand perspective.
Mr. Solomon?
Representative Lucas, thank you also for the question. And coming from a long line of farmers from the outback in Australia, where wheat and sheep were the family product, a lot of sympathy for the space. Commodity prices are simply a function of supply and demand. We've had interrupted supply, we've had a global recession, and now we're getting extraordinary demand. We've never had this kind of global synchronized growth that we're going through now. So you're going to see surges in prices. But as more capacity is brought online, whether it's oil rigs or more mining around the world, these things rebalance. But right now we're in a surge.
I'm just a little nervous, having increased the national debt from 20 trillion a year and a half ago to 28 trillion. That seems like a rather expansive increase in the monetary supply. And as the economy picks up, and what's the term, velocity of circulation increases, I'm just nervous. Anyone under 60 did not live through that period. When Mr. Volcker decided to bring it out of the economy, it almost wrung a lot of us out of existence. That said, second question. As Congresswoman Wagner discussed, the Biden administration has proposed more than $4 trillion in spending for the American Jobs Plan and the American Families Plan, of which the administration plans to finance with a hike in corporate and individual taxes. The administration's also proposed a global minimum corporate tax rate. While we should level the playing field for U.S. businesses, some argue that global minimal corporate tax rates would be disadvantageous to U.S. companies. Mr. Diamond, could you comment on this concern and how feasible this proposal would be to actually achieve a global tax rate?
Yeah, so America would be the only country, I think, in the world that would have what you would call a global tax rate. I pointed out earlier that going from 21 to 28 isn't the issue, because people say it's halfway back to what the tax cuts were, but the tax increase because of something like that is actually 4 times the tax cut of 2017. There's no question in my mind that at the margin, not for every decision made, but at the margin, that will drive capital and eventually brains and R&D and investment overseas, and that would be a mistake for America.
Ms. Frazier, could you share your thoughts on how feasible a global minimum corporate tax rate is?
I think it's very hard to get other countries to sign on to an equivalent program, despite some optimism of doing so. I think that will be extremely difficult, and therefore it could put the US in a position of being less competitive around the world.
My background representing an agriculture and an industry, energy industry kind of a district, those international markets are critically important for us, and we've gone through trade wars beyond belief for the last 50 years trying to have fair access and be able to compete. I'm just very sensitive about undoing the progress we've made, just as I'm very sensitive about setting off the Carter era kind of an inflation wave too. Thank you for your comments, and yield back the balance of my time, Madam Chair.
Thank you. Thank you very much. The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for having this important hearing. You know, institutional investors are monitoring racial and equity commitments. For example, BlackRock announced in April that they pledged to conduct a racial equity audit to integrate equity and inclusion into all aspects of their business model. Additionally, here in New York State Comptroller announced in February that the state's retirement fund will submit shareholder proposals on conducting racial equity audits, including calling upon Amazon to conduct such an audit. However, many of you seem to disagree with this idea. So let me ask, Mr. Diamond, first, your JP Morgan's proxy statement states that, and I quote, conducting a racial equity audit would not provide us with useful additional information. And Ms. Frazier, similarly, we've heard that the bank recently urged its shareholders to vote against a similar proposal. So could both Mr. Diamond and Ms. Frazier, could you elaborate on your opposition to independent racial equity audits?
And so I'll start. And you know we're devoted to the principle of trying to do a better job for the Black and Latinx community. We've announced an extraordinary amount of programs that you're welcome to come and look at. And we, you know, from community branches, I just visited one in Harlem, to $30 billion for affordable housing and mortgages for Black folks, for small business enterprise, for getting kids through high school. It's pretty extraordinary. It's pretty global. I think a lot of the other companies do it too. We're doubling down after the murder of George Floyd. So the company's completely devoted, and we report it out. That is completely different than the bureaucracy and BS of having outside orders come in to certify something. I'd rather take our time and our effort, put it in the effort. If there are best practices that we can learn from, we'll learn from them. But this kind of thing is not going to make it much better over time. It just adds another whole layer of unnecessary cost.
And from the city end, you know, we feel we have been very transparent. We just put out another very extensive update on our $1 billion action for racial equity plan, you know, that covers all different dimensions of the bank's activities, both inside the bank and outside, many of which are verified by third parties. So we didn't think it was needed to have a separate audit, but it is something that we're looking at again, given it was brought up by our shareholders.
Yeah, I think it's something, in reply to Mr. Diamond, you say it's not, unless you can verify something with an independent audit. I mean, I've seen in my time here, for example, internal audits, like that's what happened with Exxon. Something that wasn't verifiable, you put in, you get the figures that you want. But if you're having someone come in independently to verify what's going on, then it is something that is trustworthy, not something that may be just in favor of a particular company or financial institution. So I think that independent, and that's why independent audits for various institutions are always important, just as an independent audit on whether or not these commitments are lived up to. But I have just a minute. Let me go to ask them, I'm pleased to hear that many of you have committed significant capital investments towards minority depository institutions. And I've really been encouraging such investments over the past few years, along with Mr. Green and Chairman Waters, and a number of other members on this committee. And I would love to hear more about the implementation because a commitment to invest is very different from an agreement to invest. And I'll be asking all of you for written responses to this question. But in the meantime, Mr. Schaaf and Mr. Monahan, can you let this committee know whether or not your public commitments to invest in NDIs has or will result in direct agreements with these institutions? Start with Mr. Schaaf.
Congressman, we have agreements with 13 Black-owned minority deposit institutions representing $50 million of equity commitments. And that's separate from the commitments that we've made to the CDFIs, where we've committed another $250 million, and we've already given out $150 million of that 250.
Mr. Monahan?
Congressman Meeks, we have completed, and the money is in common equity for 17 institutions to date, up to 5% based on what they wanted. We've made offers to the other 120 or so that are out there to similarly look at investing in them. Many don't need the money and told us they don't want the equity. So we've gone literally institution by institution to make the investments.
I'm out of time. I yield back, Madam Chair.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair, and to all the participants. I intend to touch on a few issues, but also that my previous colleagues have touched on, but I want to go explore some other things. And to Ms. Frazier, congratulations and welcome to the frying pan. I want to talk a little bit, and I'd like to hear very quickly from each one of you. What do you see as the greatest threat to our financial system right now, and to your company as well, Mr. Monahan?
Well, as a financial institution, the number one question is what's the economy going to do? Because
economy, okay. All right, I need it really brief. Ms. Frazier.
Cyber security, given
Cyber.
how much of the private infrastructure sits in, or the infrastructure sits in private hands.
Okay. How about Mr. Solomon?
I'd highlight 3 things we were focused on: cyber, central clearing risk, growing government debt around the world.
Okay. Mr. Diamond.
Public policy not being properly executed in the United States of America, which means we may not be able to take leadership role in the world for the rest of our lives.
Okay. What does that mean exactly?
I think we've done public policy not particularly well when it comes to infrastructure, immigration, healthcare, taxation, regulation. We've stifled the formation of small business. American leadership really matters. And if we don't get our academic act together, we won't be a leader in 20 years.
Okay. Mr. Gorman?
Narrow cyber, and specifically the potential impact on consumer data and data privacy.
Mr. Scharf?
Cyber.
Okay. So to paraphrase my friend Mr. Perlmutter in his opening, one of his goals is basically to have safe and sound lending and banking for everyone. I wholeheartedly agree. Now, what's interesting to me, though, is only Mr. Diamond came close to talking about sort of the social issues side of things. Yet all of you have indicated that by 2050, you intend to be at a zero emission scheme within your banking system. Mr. Solomon, I guess you've outdone everybody by saying 2025. And I'm curious, I didn't hear climate in any of that. Closest, again, was Mr. Diamond. But why the hell, why are you spending so much time and effort into this? And Mr. Diamond, you were just expressing why you felt frustrated that you would have to be going through formal audits of these things because it's not necessarily productive. And I'm very concerned about the pressure that you all are receiving as CEOs and as an organization. By the way, I'm curious. I would like to hear from everybody very quickly whether you're banking in Taiwan or not, or are you going to John Cena yourselves in this? So if anybody isn't banking in Taiwan, I'd love to hear you. Any clients that are not in Taiwan? Everyone else is in Taiwan, or you do not have any clients in Taiwan?
Congressman, it's Wells Fargo. I don't know the answer to the question, but we can get back to you.
Tell you what, let's reserve that. I'd like to hear back from everybody because I think that is another pressure point, as one of my other colleagues, Mr. Lukemeyer, was talking about. But here, all of your firms have pledged fidelity to this whole notion of bowing to the wokeness that's going on environment. And I'm curious, and Madam Chair, I'd like to submit for the record a letter that is from 15 different state treasurers, led by the West Virginia State Treasurer, to former Senator Kerry, Secretary Kerry, the special envoy now, indicating that they are going to be coming back to you, their financial institutions, who they do over $600 billion worth of business. Now, I know in DC we're spending trillions like it's Friday night poker money. But $600 billion is a significant amount of business for everybody. And I'm curious from everybody, have you seen this letter? And what is your response to that? And basically, they're saying if you are going to limit our ability to have companies in our states in energy sector, in oil, gas, coal, we're not going to do business with you. Are you aware of this letter, and what's your reaction? Mr. Diamond, you're first on my screen.
No, we think that climate's a serious issue.
I understand. Are you aware of the letter?
Yes.
Okay. Is anybody unaware of the letter?
I have not seen the letter.
Okay.
I have not seen the letter either.
All right, we'll ship it over. We'll make sure that you get that. I know my time is up. I do want to hear about LIBOR and SOFR as well. And I will submit some questions in writing on LIBOR and whether SOFR is the answer for this problem. And I yield back.
Gentleman's time is expired and your letter is submitted without objection. Thank you. We'll move on. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Chair Lady, and I am so excited to be on this panel at this time because we have a major issue here. I want to talk about our unbanked, underbanked, as we apply that to the child tax credit that has been in this, because we have an excellent opportunity here with you all who are the leaders. Mr. Jamie Dimon, Ms. Frazier, Mr. Monahan, Mr. David Sullivan, Mr. Scharf, and Mr. Gorman. You all represent our largest banks. And I want to put this to you. We've just passed the Child Credit, expanded the Child Tax Credit Act in the 199 trillion COVID relief package. Here's what it does. $3,600 for children under 6, $3,000 for children under 17, and each of the parents are getting guaranteed checks every month. But here's the problem. They cannot do this and receive it with direct payments. And that's what I am concerned about. To help us to make sure that their child tax credit payments can come by way of direct deposits. It's dangerous out there when they don't get it directly. These large series of money every month got to go to a payday lender or somebody on the check cashing service where they got to pay money. So we need to find out what we need to do about this. So, Ms. Scharf, let me talk with you because Wells Fargo has the largest number of branches. And I also checked with our Federal Deposit Insurance Corporation. And let me give you these statistics. 13.8% of Black households are unbanked. 12.2% of Hispanic households are unbanked. But you know what it is for white households? It's less than 2.5%. So it seems to me, my bipartisan colleagues, Reverend Cleaver, myself, and Congressman French Hill from Arkansas has got a bill moving. It's over in the Senate now for financial inclusion. Tell us, if you can, what we must do. 70% of our African Americans live in neighborhoods with no branch bank. So please, Mr. Reif, you may start. What are you all doing? What can we do? Is there something we can add to our financial inclusion bill? Reverend Cleaver, myself, and Mr. French Hill from Arkansas, I'll be glad to work with you. Mr. Reif, you got the largest numbers of branch banking. What percentage of yours is in the Black neighborhoods?
Congressman, I share your concern on the issue and also the desire to make changes. And we as an institution are committed to bringing about the change that's necessary to bring more of the individuals that you're talking about into the system.
What would be that change? A move to put more branches available, reach out to community organizations, get these accounts established. It's dangerous.
I think it's a combination of financial education. It's a combination of product design, and it's it's also about having the right kind of facilities and the right kind of partners outside of the big banks themselves to ensure that what we're building is serving the needs of the community.
Mr. Diamond, what about you?
It's financial education. It's us doing a better job reaching out to the community. And like Charlie said, it's working with CDFIs and MDIs to improve that outreach.
All right. What about you, Mr. Solomon?
We have a very, very small consumer business. We have no branches, but I do think at a high level, just commenting generally, the comments that Mr. Diamond and Mr. Scharf made are correct. Financial education, using the network of CDFIs, mission-driven lenders, et cetera, for better reach out.
Well, I hope y'all know we got to solve this problem. We can't leave these people. Many of them are single-headed household, people with disabilities, with no bank accounts. They're out there, and the predators are waiting on them. We got to get their red
time has expired. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
To our witnesses, thank you for your time today. Each of you or your predecessors signed the Business Roundtable's 2019 restatement of purpose of a corporation, subordinating shareholders to so-called stakeholders. As yesterday's hearing in the Senate Banking Committee demonstrated, this redefinition of a corporate purpose did absolutely nothing to placate or appease Senator Warren or the extreme far left. In fact, it emboldened them. And whether you admit it or not, there are instances where the interests of shareholders and stakeholders come into conflict. For example, in October 2019, Senator Warren wrote a letter to Mr. Diamond stating that because of the restatement, she, quote, expects that you will endorse and wholeheartedly support her Accountable Capitalism Act. The bill would, among other things, require workers comprise 40% of the board and dictate that companies obtain a federal charter to operate. I'll ask each of you to answer yes or no if you could. In an event where there is a direct conflict between the interest of shareholders and non-owner stakeholders, will you prioritize shareholder interests? Mr. Diamond, we'll start with you.
Yes.
Mr. Moynihan.
As I said in my open testimony, we deliver both for shareholders and for society.
When there's a conflict, which one will you prioritize?
We will prioritize the return to the company.
Thank you. Mr. Solomon.
Yes, we'd prioritize shareholders.
Ms. Frazier.
Yes, we will prioritize our investors.
Mr. Scharf.
Yes, our shareholders.
And Mr. Gorman.
Generally, shareholders, there are circumstances where it's a no. Last year, we guaranteed every employee their job as stakeholders. That was obviously to the detriment of shareholders if we hadn't been profitable.
Well, thanks for mostly keeping in mind your fiduciary duty to shareholders. 3 of you signed on to the Net Zero Banking Alliance, while 3 did not. The alliance is part of President Biden, John Kerry, and Bank of England Mark Carney's misguided plan to weaponize the financial system and politicize it to choke off funding to legal fossil energy businesses. Joining the alliance requires your institutions to submit information to the United Nations so they can certify that you're green enough. Mr. Diamond, you did not sign this. Why not?
It was too vague. It's hard to meet the commitments. We've already made a very detailed public statement about what we're going to try to accomplish. We've been working very closely with auto companies and oil companies and utilities to figure out how to do it the right way. We need to do this the right way, and signing statements is not the right way. Over time, there will be better disclosure of what people are trying to get done.
I appreciate, as we discussed, your commitment on this in your shareholder letter as well. Mr. Moynihan, Mr. Diamond says he doesn't need John Kerry, Mark Carney, or environmentalists at the UN to tell him how to manage his risk or run his business. My question to you is, should access to financial services be tied to the creditworthiness of borrowers regardless of politics?
Creditworthiness of borrowers is the primary way we underwrite credit, yes, sir.
That's good to hear. Thank you. And I would encourage all of you to prioritize credit risk as opposed to politics. Finally, on fossil energy, does anyone on the panel think it's a good idea to immediately and completely cut off financing to fossil energy? Please raise your hand if you think it's a good idea to immediately cut off financing for fossil. I want to let the record show that none of our panelists believe that that is the case. Unfortunately, some of your financing commitments, combined with the administration's desire to, quote, change the allocation of capital in energy, are disrupting supply without doing anything about demand. Data published even by the Biden administration concludes that fossil energy will constitute more than 70% of all energy consumption in the United States by 2050. This supply-demand disruption will raise prices for consumers and cede economic competitiveness to countries like China. In 2020, Citi's, J.P. Morgan, Goldman, Bank of America, and Morgan Stanley had a combined $77.8 billion in exposure to China, up 10% from 2019. And yet, China is responsible for more than 27% of total global GHG emissions. Are any of you mandating the same environmental standards in your Chinese investments as you work with American companies to help them with the transition? Anyone can offer your opinion.
Our standards are worldwide.
Our standards are global, too.
Our standards are also global.
Ms. Fraser?
It's a global policy, yes. It's the same.
I'm running out of time, but I appreciate that approach.